Good morning. Welcome to the new week. Hey, Steve. Good to have you guys. JK, good to see you in here. I heard you were going to come in, start doing a little training with us. Good morning, Bob. Great to have you guys in here. Cav, hope everybody's doing well. Hope you guys had a great weekend. Had an awesome weekend. Super relaxing. Did a little bit of study. Did more hanging out than anything, and that's kind of a nice thing to do. Awesome. So guys, we're going to get going. We're going to have some fun. Did some studying, ready for some beta testing? I love it, Josh. Me too. John Novak and I talked a little bit over the weekend about that. We're looking forward to it. Hopefully Tuesday or Wednesday, we'll have you guys start trying to break stuff. And as long as everything goes as well as we anticipate, hopefully March 15th is the projected date to start funding. And then the browser version should be available a couple weeks after. So a lot of exciting things going on with Nexgen. We're excited to start this new chapter, and we're excited to do it with the same approach. The goal is your success, always, guys. And that's what this classroom is. The goal of this classroom is to help you find the success that you want as a day trader. We start that by checking news, guys, and in 1 minute, we have some high impact ISM manufacturing news, which means that the market might spike. It could jump. It has the potential to change direction. And it's important that you understand when these red flag news events are happening, because they really can. You could be in the perfect trade with every advantage, every rule met, feeling great. News is released, and then somebody with $1 bajillion in their pocket says, nope, it needs to go the other way. And that emotional reaction is what you're avoiding when you check news every morning. So I go to forexfactory.com. I look for these red boxes. I even look for these orange boxes, and I just say to myself, hey, I'm going to go do something else. Instead of hoping I don't get run over, I'm going to do something else. And what you'll find too is that it's such an impactful moment that almost every trading funding company that's out there has a rule. You can't trade. You cannot trade during news. You can't try to ride that news wave, because it really is. It's luck at that point. So I go here every morning when I drink my coffee, charts are loading, and that's exactly what I do. Everything that I talk about is going to come from the Nexgen page. I really don't want to keep any secrets from you guys. Nexgen doesn't keep any secrets from you guys. And when you go to the trading guide, which is where really all the answers are, there's a lot of information here. There's so much information Nexgen's put together over the last 30 years of teaching people. There are video series, and there are everything you could ever hope to know about anything, guys. And that's not how I teach the room. Just a heads up. I'm going to go to the frequently asked questions. I'm going to scroll down a little bit. Close your eyes. This is what I do. I talk about a high probability trade every morning. I talk about 3 rules every morning. I talk about a trade that has been proven to win more than it loses. I talk about a trade that typically wins 70 to 80% of the time. I talk about a trade that creates confidence from the memory of success, guys. And I talk about this trade every morning because this is the trade that's going to give you a little bit of autonomy. This is the trade that's going to teach you to learn to read your indicators. It's going to let you recognize advantages, and then you make the decision on whether or not it's your pattern. I am not the trade police. I am the guy that teaches you to read your indicators so that you can create your plan. And I like that job because what it does is it absolves me of being active in your decision-making process, but I get to give you that foundation, so hopefully your decisions are good ones, and you'll know if they're right for you. Everybody's different. That's one of the beautiful things about trading. One thing that you'll find is that chart reading is about 90% of your day. Looking at indicators is about 90% of your day. Not having an advantage, an edge, is about 90% of your day. It really is. I woke up at 4 a.m. Central this morning. Took a nap yesterday. Ugh, I never do that. Couldn't sleep past 4. Between 4 and 8 a.m., I took one trade. That's it, just one trade. One time where my rules were met perfectly, my entry was given. That's it. Good morning, Jeffrey. And it's okay because I reached my goal in that one trade. And now I can go do whatever the hell I want after class because my trading day is done. It's nice when it works that way. 90% is waiting, 10% is actively trading, guys. But once you can read your indicators, once you can look at your chart and start talking to yourself in terms of advantages, you're going to understand where the market is likely to continue. This is your entry point for the high probability trend trade. You're going to understand where the market is likely to go. This is going to help you with profit taking, and you're going to understand where the market is likely to stop. And man, that's the one that really, I think, is one of the most important things you can understand. These are termination conditions. That's that giant red flag saying, hey, don't take the next trade into this area. It could stop the market. Your high probability trend trade is 3 rules. That's it. 3 rules. Each rule, when true, creates an advantage. So the recipe for a trade is the accumulation of these 3 advantages. Rule number 1 provides the advantage of momentum. Momentum is phenomenal. Momentum shoves a market in the direction of the trend. Momentum can break key areas. Momentum can even cover some mistakes that we tend to make as new users. And momentum is rule number 1 for a reason. I want you to picture a semi loaded down, full freight, tailwind, downhill, 100 miles an hour. It's just hard to stop. Rule number 2 will keep you from trading into those areas that may stop the market, making sure that there's room to profit targets, and we're going to call this the advantage of a clear path. So what that means is that loaded down semi doesn't have traffic, doesn't have a brick wall, there's not a building in the way, it's even harder to stop. These first 2 advantages, momentum and clear path, guys, these are your foundation. These are the 2 that once you can recognize them, that's when you start to build outside of this very basic plan. That's when you start to see more, find different entries, take different trades. So we're really going to build that foundation. Rule number 3 is designed to get you into the market where the market is most likely to continue. Rule number 3 is specific to a trend trade. And rule number 3 is going to help you reduce risk. It's going to help you increase profit potential. So it's only 3 rules. The first 2 are going to become your universal rules. These are the 2 that are probably going to be a part of every trade that you take. And these 3 rules for the high probability trend trade happen on only 2 charts. Large chart is a very broad stroke of a brush. It's a slow moving chart. It's difficult to see change on a large chart. The large chart will define the direction that you should be trading. The background color will let you know as a brand new user whether you are going to be trading with the trend by following the trend. And one of the biggest things you can do to avoid losses as a brand new user is just always trade with that trend. Go with the flow. It's going to define the momentum in the market through rule number 1, and it's going to define the areas that could stop the market, that could create a reaction, that could stop your forward progress. So rules 1 and 2 are met on the large chart before you ever look for an entry. Rules 1 and 2, again, are those foundations, and the cool thing is it's not a very complicated process. The first bar, the first printing bar on that large chart will define direction, momentum, and areas. It'll give you the first 2 rules, 66% of your advantages. Once they're there, once they're true, we're going to go to a small chart, and it's a faster chart. It's a refinement chart. The inner workings of one of those bars on the large chart, inside of that bar, is 26 ticks of information. And a tick is the smallest movement the market can move. So on this small chart, there's going to be up to 20 or 30 bars that you'll see. And it's taking an X-ray of those large chart bars, and it's refining and pinpointing where the market is most likely to continue. That reduces risk, that increases profit potential. And rule number 3 is specific. to the small chart. It's designed for entry. Hey, good morning, Izzy. And we use these two charts. And again, you know, I'm talking to new users. I'm talking to people that aren't successful every day. I'm talking to people that haven't built their own plan, optimizing chances of success. Your large chart is a large crowd, guys. Think of them that way. These are the men and women with the money and the influence to create trends and create momentum. And these are the people that react at key areas on those large charts. And if you just simply allow the large chart to lead the way, if you trade with rather than against, if you go with the flow rather than fight, your chances of success go up dramatically. But there are fighters, and we call them the small crowd. This is the small chart. And these folks fight the large crowd. They fight the overall trend. They fight the momentum. They fight everything. And their fight is typically short-lived. This small crowd typically loses 70 to 80% of the time when everything on the large crowd says up. Hey, good morning, Erla. Or everything on the large crowd says down. We use their fight to pinpoint our entries with rule number 3. We literally, through rule number 3, pinpoint where they're most likely to fail. And the cool thing is that if they're failing 70 to 80% of the time, guys, you're having the potential to win up to 70 to 80% of the time. I like that. That's a great win percentage, guys. And what you'll find is that all these rules is the description of a pattern that has been proven to win more than it loses. That's it. This is, all you guys my age, this is that pattern on the video game that keeps your quarter alive, that gives you those extra lives, that keeps you running from the ghosts instead of getting eaten by them. It's just a pattern. The market repeats itself every day. So we're going to learn the pattern. We're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. This is the first hour of this classroom every day. It's the same hour every day because recognition creates repetition, guys. This says when it's okay to trade. I don't know if my brother did this intentionally. I encourage new users to have two options in the beginning. Either your rules are met, at which point you will enter a trade, or your rules are not met. And it's time to sit on your hands and do nothing. Embrace that 90%. Let it be that black and white in the beginning. You'll find your shades of gray. You have the ability to simulate, to practice, and to post pictures in the class until you're sure you have the correct rules, to make sure that you're not breaking the rules, to make sure that you're reading your indicators correctly, to make sure that your entries are the lowest risk and your profits make sense. And guys, every time you post in the room, that's the first step to becoming a confident trader ASAP. And I'm not the trade police. I can't stress that enough. I'm not the trade police. My job is to teach you to read indicators. And I posted this in the room and I'm just going to read it out loud. To minimize your learning curve, post pictures of your trades in the class. Every trade, win, lose, or draw. And if you win and the rules are wrong, you may have a short-term victory, but typically it's a long-term failure. And how are you going to know the difference? To be sure, you need feedback, and we're here to help. And if you place a trade on the simulator, if you participate in class, there's no risk of loss or capital. You need someone to tell you what you did right or wrong when you're new, guys. And that's part of the educational magic, and that's really what we do. Is I look at your charts and I say, hey, here's the advantages, here's the disadvantages. So every time you post in the room, it's like getting a private session. Here's the one thing that I am going to respectfully request of you guys. Write your rules on the chart. Talk about the advantages. I don't need you to draw an arrow to your entry and say, I entered here. I can see it. Tell me why you entered there. Tell me what got you in, especially if you're one of my traders that are way outside of those high probability trend trade rules, guys. Write your rules on the chart because your rules should be proven, right? Your rules should have shown you that they win more than they lose. So if nothing else, I can't write your plan for you, but I can definitely hold you accountable to the consistency of your plan. So do me this favor. Every time you take a trade, talk about the advantages, show me your entry, tell me why. Show me your exit, tell me why. And what happens is I'll give you everything in my knowledge bank to help you get a little better, to see if there's anything I recognize, good or bad for the trade. I'll give you that feedback and you can do with it what you will. We're going to simplify today. We're going to talk about this highest probability trend trade. And once you understand the very basic concepts, once you can understand momentum, path, and entry, it opens the door for more trades. It opens the door for what we call medium probability trades. And a medium probability trade means that most of your indicators agree for the trade, however an issue exists. It's your chart reading that is going to define that issue. And it's just going to be the omission of one of the advantages. You can still take these trades. There's still a lot of opportunities. You just have to manage assertively. So you really need to learn these Fibonacci trigger looks so that they become easy, so that you can identify advantages quickly. And that's the second piece of getting to where you want to be ASAP, guys. Let me open up my spreadsheet. I thought I had it open, but I didn't. Use the spreadsheet. I give this to you guys every day. I've been giving it away for years. Nexgen, this has been a staple in the downloading of the software. It's in your Nexgen Study Picks folder. Even if you go to the CME and you say, hey, I want to be a day trader, what should I do? The first thing they tell you is, gosh, keep a journal. I got a copy of an awesome journal that covers wins and losses and all that sort of stuff this weekend. So you can make your own, or you can use this one. This one is set up to not only take a picture of what you did, but to talk about the advantages. And I think more importantly, for new users, there's a giant section for feedback from the classroom, because as you're learning to read your indicators, very often in the heat of battle, you can miss something. When you're in the moment, when you're trying to make money, you begin to focus on money instead of patterns. And if you drop it in the classroom, guys, remember that I'm looking at your pictures without the pressure of wins or losses. There's no anxiety. There's no fear, guys. It's nothing but chart reading, looking at advantages. And that kind of coming back to the still picture instead of in the moment, you see a lot that maybe you didn't see in the moment if you go back and study these. So I always tell people, take your pictures, jot down the feedback, and then go back and study these pictures every morning. And you'll begin to see patterns that are bringing you success. You'll begin to see things that are taking it away. And if you are recording the feedback, you're going to see the same feedback over and over. And everybody's got a pattern. Everybody's got a thing. Some people are early. Some people are late. Some people fight. Some people chicken out. Whatever. You give me 4 or 5 pictures in the room, I'm going to know what your pattern is. So that's the last tab. I want to go back to the first tab. This is the recognition creating repetition, guys. This is recognizing advantages on the large chart. This is strong triggers, over 50 pictures of them annotated, showing you what it looks like and telling you what it means to you. Same thing with the clear path, rule number 2 being met. And then also what it looks like when those rules are not present. That's your 90%. I don't have strong triggers. I'm going to sit on my hands because they're weak. I don't have a clear path. It's one of those termination conditions. I'm going to sit on my hands because I like advantages. I want an edge. I want to win more than I lose. The second tab is the client trades. These are over 400 pictures of you guys doing pretty cool stuff with the software. Almost all of these revolve around momentum and path, or into medium probability trades that are managed effectively. Use it as a study guide. If you have a picture or a question about any of them, drop that link in the room. We'll talk about it. There's the entry sequences for both longs and shorts, management, very mechanical in the beginning. This will be on the plan that I give you. And then ways to manage a little more aggressively. Patterns that you're going to see on your charts every day. I've pointed out a lot of them, but your job is to go to the next one and you start pointing out your patterns. You're going to recognize things. Take pictures. Take pictures as you learn to manage. Take pictures of the pattern that it's going to take to get you into the market, your pattern, your trading plan. Remember, trading is a solo sport. My job is to teach you to read indicators. Your job is to make decisions based on what you're reading. And as you learn to do that, get a little feedback in the room, but start taking pictures. So we're going to get into the first hour. My promise to you guys, and I do this every day, I'm going to give you everything that you need as a brand new user to be successful with the software. I'm going to hand you a solid plan that optimizes your chances of success. I'm going to give you everything that you need to be able to study, to back test, and to prove that this is right for you. Your job is going to be to do the work, to take some pictures, to ask for help, to use that spreadsheet, to study it, to make sure that you're learning patterns. And we're going to start with just what you're looking at every day. It's amazing to me how many people show up and they don't know what a trigger is, or they don't know what a fib is. I didn't. So maybe it's not amazing. Maybe it's absolutely normal in human nature. So what I did is I'm naming the parts, guys. And triggers are the first part we're going to name. There are small triggers. They're a fast-moving average. There's large triggers. They're a slow-moving average. They're the same no matter what time frame. It's always small and large. And that's as much as you need to know about them. Small and large. You're going to use them to define momentum. You're going to use them to define termination conditions. You're going to use them to define entries. And all you need to know to make that happen is that the solid lines are small and the dashed lines are large. And then each chart's going to have areas. And depending on the chart, they're going to have a different function, but they all have the same name. There's going to be divergence highs and divergence lows. And divergence is just a way of saying, hey, we're losing momentum. The sellers stole the momentum from the buyers at a high, or the buyers stole the momentum from the sellers at a low. You'll see that pink or cyan line print. You're going to see red Fibonacci resistance. You're going to see blue Fibonacci support. You're going to see yellow 1-to-1s, and you're going to see a mid-band. And again, they're going to be used in different ways. On a large chart, they're going to define where the large crowd is making decisions. They're going to define where the trend may end, where it may reverse, where there may be big untradeable bounces. On a small chart, they're going to define your entries. So just know the names. And then I'm going to teach you how to use both triggers and areas to take the highest probability trend trade, to get the best of the best entry, because great entries, guys, they reduce risk. So if you have a question, interrupt. If you don't understand something, raise your hand. If you need me to repeat a lesson, to say it a different way, let me know. I'm always happy to. My favorite classrooms are when the first hour takes an hour and a half, because you guys are asking amazing questions. So we're going to start on a large chart. The slow chart. The large crowd is going to define direction and momentum. And rule number 1 says that the large chart must have strong trigger lines for that first advantage. In order to have strong trigger lines, you need to trade with the trend. If the background behind that first bar in the large chart is green, you're in an uptrend. If the background is red, you're in a downtrend. All this does is tell you which way you should be trading for the highest chance of success. There's an old adage, the trend is your friend. It's true. In an uptrend, when the background is green, both the small and the large triggers must also be green. And in a downtrend, both the small and the large triggers must also be red. And if the colors don't match between the two trigger lines, between the trigger lines and the background, you don't have strong triggers. Rule number 1 isn't met. And what it means, this is your look. And this is always the look. In an uptrend, small triggers above the large triggers wide, the space created between the two. We're going to take a picture today because it's Monday. That space that's created between the two, and I want you to think of scissors that have been opened and they are ready to cut. When your scissors open, when there's space between the triggers, when the blades are separated from one another, guys, this is when the odds are favorable for the market to continue up or down. This is when the market is most likely to continue in the direction of the trend. This is the look that has the potential to break those key areas. This is the look that'll cover mistakes. This is the look where we're going to buy support and sell resistance, guys. Rule number 1, momentum, separation between the small and the large. It's hard to stop this look. And then when the small triggers work back and work their way inside of the large triggers, this is what we call weakness. And when I have weakness, anything can happen up or down. This is the absence of that odds favorable momentum. So in the classroom, you're going to see strong triggers annotated as OFM all day long. OFM, odds favorable. And then once those scissors close, once they return inside the large, it's going to be weakness. And when I have weakness, anything can happen up or down. Hey, good morning, Wayne. So rule number one is it's consistent no matter which time frame you're looking at. And I'm just going to show you here. When there are strong triggers up, whoops, what did I do? When I have strong triggers, this is when the market is most likely to push. This is when key areas are most likely to break. When I have weakness, this is where bigger retracements typically happen. This is where fights happen. So strength is always strength. And weakness is always weakness. And only one is an advantage. The cool thing is when I have strength, very often in that one bar, it looks like it sprouts a tail. Guys, that's the fight on the smaller, faster chart. And you're going to get to a point to where you're going to look at that large chart and you're going to see these tails and you're going to say to yourself, man, there may have been a trade there. There could have been a potential entry. So I want to ask real quick, is everybody good with the idea? Separation is strength. And it's pretty universal, guys. Separation is strength. There's weakness, reversal right at a fib. Separation is strength. Let it be that black and white. Let it be that basic. Let it be that focused in the beginning. Give yourself that first advantage. On those large charts, those tails, those wicks, those are all potential entries. So when you have strong triggers and you see one of those tails on the large chart scrolling back, looking things over, this will help you see the opportunities that there may have been in the market. These are all potential entries, whether it is up or whether it is down. You're going to use this concept to go back and study and prove and back test and say to yourself, man, I'm going to create this recognition of the pattern. So strong triggers lead the way, guys. Rule number one for a reason. Momentum. There are some of you guys that trades based nothing but momentum. It's screaming, it's hard to stop, I'm going to jump in. I see it all the time. You can make that advantage even better without a termination condition, not trading into areas that are likely to stop the market, making sure that you have room to the profit targets. We're going to call this a clear path. Guys, when you have all the momentum, when the odds are favorable for a market to push, and then you find yourself with a clear path, it's, oh my gosh, it's a free fall, or it's a rocket ship, and it's hard to stop that market. Termination conditions are just Fibonacci-based indicators that may reverse the market, and it's based on a comparison of those areas, those ones that we talked about, horizontal lines on a large chart, on a big chart. We're going to compare them to the trigger lines, and they're going to let us know whether or not we should pump the brakes and sit on our hands, or whether it's just go, go, go. These areas on a large chart, whether it is support, resistance, one-to-ones, divergence lines, this is where the large crowd's making decisions. This is where the people who control the markets are most likely to react, whether it is to fight, to create an untradeable bounce, to reverse the market, or to break. One of the things that I've found to be really an absolute in trading, and there aren't a lot of absolutes in tradings, I don't want to be a part of their decision-making process. Nexgen gives you the ability to recognize exactly where things could change, and the hardest thing you'll ever do is absolutely nothing when price gets to that area. So to define a termination condition, we're going to let the large crowd get to their decision-making point, which means that if the buyers are in control and everything is going up, when price reaches Fibonacci resistance, I'm going to ask myself, you're going to ask yourself, where are my triggers? If the triggers remain below resistance, resistance can be a divergence high, a red Fibonacci resistance line, or yellow one-to-ones. When price reaches resistance, I'm going to say to myself, somebody might make a decision. The triggers are below, it's a termination condition. All it means is that that area could create an untradeable bounce, a bounce that could take you out of a long position. It means that the buyers and sellers, the large crowd, they could fight. And it's not uncommon to see the market dance right at these key areas. It could break, absolutely, more likely to break with momentum, or it could reverse the market 100%. You could go from up to down. Those large triggers could roll. And guys, if a termination condition reverses the market, we call that a strong top. And a strong top is the precursor to the highest probability trend trade you can take. And a strong top is rule number one for those medium probability 50-50 trades you're going to get on your plan. A strong top is rule number one for the high volume area trades, for momentum trades, for white bar breakout trades that John Novak teaches. And guys, that strong top says no more long trades. Anytime rule number two is not met, just don't trade into the area. Wait for the reaction. Sellers are in control. Everything's going down. They reach Fibonacci support. You guys say, where are my triggers? The triggers remain above support. Absolutely no trades into that area. Rule number two isn't met. You don't know what the reaction is going to be, and your safest bet is to wait for the reaction. Let them tell you what's most likely to happen. Is it going to bounce? Is it going to break? Are they going to fight? Is it going to reverse the market and become a strong bottom? And guys, these are the areas where the large crowd is making decisions. And from Fibonacci resistance, the market traded all the way down to Fibonacci support. And from Fibonacci support, it was right back to resistance. And this is where the fight appears to be happening. Termination to termination to termination to termination. And they still haven't broken out of the range. Guys, when John Novak was developing the algorithm to create these Fibonacci areas, he used to talk with a buddy of his that worked in the pits in Chicago, and the guy's job was to know where the institutions were buying and selling. He couldn't give John Novak the numbers, but John could give him his numbers. And when John Novak started becoming a quarter, 25 cents away from those numbers, that's when Nexgen began. That's when they hit the market. Guys, look at that. Fibonacci support with weak triggers, and look at the reaction. Could have saved you. Could have saved you from a loss. Straight to Fibonacci, and then it just broke. So, is everybody good with rule number two? Exercise a little bit of patience. 90%, guys, that's what we're seeing here. Doing nothing. They break. Fibs break all the time, guys. They really do. But this is what it looks like when a fib breaks. And I really like this picture. Because if you get to the point where every time you look for a trade, you're picking one of these for rule number two. The first one is price reaches, no triggers, no trade. Wait for the reaction. Sit on your hands. Do nothing. Rule number two is the most broken rule among new users because rule number two forces you into that 90%. If an area is really going to break, if it even has the potential to break, your small triggers have to smash through that area. They've got to get way above resistance, 2 to 3 points. But you'll notice that your large triggers are still below the area of resistance. Guys, this is what we call a 50-50 look. 50% are through, 50% are not. On the plan I give you here in 20 minutes, I'm going to give you the rules to take that trade with the highest chance of success. Because that potential to break is awesome. But it's not a clear path yet, which means that you're up against something, which means you have to manage assertively. It's only when both lines of the small triggers and both lines of the large triggers get above the area of resistance. Resistance is now broken. It will behave as support. And guys, with that momentum and this clear path, you're looking for entries on that small chart until the next area is reached. And once you reach the next area of resistance, we're right back to number one. Same thing for shorts. First, it's a termination. Your best chance of success is to do absolutely nothing and be okay if it breaks. It'll show you the potential and then it'll break and it'll remain broken until you reach the next area. Guys, rule number two is going to keep you out of a world of hurt. Rule number two is going to keep you out of a lot of trouble. And I just crashed NinjaTrader, it looks like. So I'm going to have to go back and reopen it. But we saw it. We saw rule number two keeping you out of consolidation on crude oil. The next termination condition on the list that I showed was 3 divergences. And 3 divergences in the same price range may terminate a trend, guys. 3 divergences in the same price range can stop forward progress. 3 divergences in the same price range is the only time that the small chart will ever give you a termination condition for the high probability trend trade. And all this is the small chart showing you change that you can't see on the large chart. Remember, the large chart is a big, slow moving chart. The large chart inside of this one bar, you're going to see bounces and fluctuations and ups and downs. And all of this inside of the yellow box here is inside of that one bar here. So if you see 3 losses of momentum on the small chart, it's saying, hey, guess what? Things might be changing on the large chart. No more short trades. Let's either let those divergences break the same way we let an area break, or let's see if the market reverses. We'll look for trades the other direction. 3 divergences on a smaller, faster time frame is the only time I'll let the small chart talk me out of a high probability trend trade. The final termination condition is the gap theory. Another one of the absolutes, I would say. Price returns to large triggers. Large triggers are moving averages, and when price accelerates away from them, it tends to return to them. And if price accelerates away from the large triggers and hits a mid-band, if those large triggers don't follow, if they're a bar away, guys, the mid-band that's the only time the mid-band's a termination condition, because price is likely to bounce and close that gap back to the large triggers. It behaves like a vacuum. Price returns to large triggers. It gets sucked back. Any short trade you take between that mid-band and those large triggers is more likely to fail. Rule number 2 is not met. This is a termination condition. And if that mid-band with the large triggers a full bar away reverses the market, even that mid-band behaves as a strong bottom, sets you up for a high probability trend trade the other way very often. So, termination conditions, guys. This is Fibonacci-based indicators giving you the heads up. This is where the market could bounce. This is where fights could happen. These areas can break, and I just want you to accept that you'll never know what the reaction's going to be. You can't predict it. You'll think you can, but you can't. And there will be times when your path isn't clear because areas are stacked. Has anyone other than me felt frustrated because you couldn't seem to get a trade because the market just wouldn't get out of that range? It wouldn't stop hitting areas and turning. And guys, this is 90% of your day. And I dropped this picture in the room. This was the NASDAQ this morning. This is 90% of your day. This is rule number 2, keeping me out of losing trades. Look at the momentum into that area, and it's still reversed. And look at the momentum directly into that area, and it's still reversed. And with all that momentum and the potential to break, it didn't. Rule number 2, guys. Rule number 2 is going to keep you out of a lot of shenanigans. A lot of shenanigans. Good morning, Black Prince. Good to see you. But it's okay. It's okay to do nothing because, guys, the futures markets trade billions every day. It's not necessary to be in every move. You don't have to be the first one in or the last one out. And this classroom is designed to teach you to recognize 3 very simple advantages that'll allow you to capitalize in between areas with momentum, the highest chance of success. In a gap situation and the market continues in the initial trade, is the entry rule the same? Small triggers resume a position above the large. If you're going to take a high probability trend trade, Iron Mike, absolutely. And this is one of the great things. Mike, whether there was a gap theory or a strong top or bottom, doesn't matter. If you're looking for a high probability trend trade, that's the only way to take it. Are there other trades, Mike? Yes. Are there other ways to capitalize on it? Yes. Do they revolve around maybe not having momentum yet? Yes. But once you understand these 2 concepts, you'll find a way. If there's a way to do it, there's people in this room, Mike, and it's pretty cool. You'll see it. They trade off of that mid-band to get back to the large triggers. And for a brand new user, not only does that fight momentum, it also fights trend, right? And there's a lot of challenges on that one. So there's ways to do it, and there's people in this room that do it. But remember that my whole goal for everybody in this room is I'm going to teach you to recognize momentum, path, and entry for the high probability trend trade. You're going to take that understanding and you're going to make decisions that are in your best interest, no matter what that may be. And it's not my job to police your trades. But when you post them in the room, Mike, show me what you're studying, right? I like when people tell me that. I've been studying it. Drop 10 of your study pictures in here. Let's talk about them. Because if I've got something in my brain that's helpful, I'll share it. But if you're not taking pictures of the pattern, if you're not writing what you see, if you're not comparing to see if that pattern wins more than it loses, then you're short-sighted on your study. Because all this is a description of a pattern that wins more than it loses. Kind of cool, right? Yeah, I'd love to see them. So guys, once you have momentum, once you have a clear path, once the large chart has told you that you have what you need to look for a trade, and let's do this. Let me go to the large crowd picture. This is exactly what it's going to look like. You're going to have odds favorable momentum. There's going to be nothing in the way. And now it's time to define where the small crowd is most likely to fail. Now we're going to wait for that small crowd and we're going to take a trend trade, guys. You're going to enter the market. And you're going to do it with a limit order, which means that you're going to wait for the market to come to you. And you're going to use a limit order to buy or sell a pullback. That's that fight, that retracement that goes against the trend. And you're going to do it at an area, at a fib, at a midband, or a yellow 1-to-1. So the same way areas on the large chart can stop forward progress, create a bounce, they do the same thing on a small chart, but now we're going to use them to go with the trend. We're going to hope they stop that little push and continue with a large chart. But the thing is you want those areas to be inside of triggers, guys. And this is the same idea from the gap theory. Price returns to large triggers. On a small chart, price will return to the 5-1 large triggers. On a large chart, price will return to the 13-2 large triggers. Your entry chart has both of them on it. And all the large triggers do is they define where the retracement is most likely to occur, where that down push is most likely to go. So you're going to use that idea to say these price bars may go anywhere from the highest line to the lowest line. So again, new users, best of the best, highest probability, most accurate, insisting on favorable large triggers as a new user gives you the highest advantage, because favorable large triggers mean that both the large and the synthetic, the 5-1 and the 13-2, they're overlapping. They're one on top of the other. They're two snakes riding piggyback. And when you have that look, you have the smallest possible area on a chart where price may return. And then when you put areas inside, fibs, midbands, yellow 1-to-1s, you have the tightest, most concise, most accurate projection of where the small crowd is most likely to fail, where the market is most likely to bounce and continue in the direction of the trend. So for brand new users, buy or sell a pullback to an area inside of favorable large triggers. When you grow a little bit, you'll find ways to capitalize when it's not quite as exact. So we're going to define an entry real quick, and it all begins with the large chart rules met. So in this particular instance, the large chart is in an uptrend. The large chart has odds favorable momentum, and the large chart has no termination conditions, which means that I'm turning my attention to the smaller, faster chart, and I need to wait for the small crowd to fight. I need to wait for the retracement to begin, guys, and that's a reversal bar. So at the time of the reversal bar on the small chart, I'm going to identify where the retracement is most likely to go. Price tends to return to the large triggers. I want you to say that in your head, write it down, tattoo it on the cat. Price returns to the large triggers. I have large triggers and synthetic triggers on the entry chart. Large triggers from both. The highest line of the triggers to the lowest line of the triggers is where the market is most likely to retrace. So the tighter, don't tattoo your cat, Jen. I was just kidding. The tighter they are, one on top of the other, the smaller this area becomes, and that helps with accuracy. So your trigger lines will define where the market is most likely to retrace. You need an area inside of triggers to define where the bounce is most likely to occur. So areas can be fibs, midbands, or yellow 1-to-1s. Guys, I am steadfast on these three areas. Fibs, midbands, yellow 1-to-1s. Not divergence highs or lows, not the triggers themselves, not pink 1-to-1s. Areas inside of triggers can be fibs, midbands, or yellow 1-to-1s. And the box from the highest area inside of the triggers to the lowest area inside of the triggers, this shows me where the market is most likely to bounce in the direction of the trend from the large chart. This shows me where the small crowd is most likely to fail. The retracement is most likely to occur inside of the triggers, but it's most likely to bounce off the areas inside of triggers. Guys, this 3-tick range is your window of opportunity, where the trend is most likely to continue. With a little bit of study, you'll be very comfortable activating a limit order 2 ticks above the highest point of support inside of triggers. And now you've done all you can do. It's up to the market to give you an entry. I want to talk about a couple common things. Very often, I see people put their limit order at the lowest point of support. And they say to themselves, you know what? I don't want to have that extra $20 risk. And what happens very often is the market gets close and goes without them, and they've got this sense of loss. I also see people who may enter at the top, at the area, but they don't want to leave much risk on it, and they'll put their risk just below the fib. And then it goes to the lower area, stops them out, and runs off to the distance, guys. So it's important as you learn the software to understand the likelihood. It's never guaranteed, but the likelihood, and let's go back to that picture because I think this is important. Every time you take a high probability trend trade, you have to believe that price may retrace to the bottom of the triggers. You have to believe, though, that it's most likely to bounce off the highest point. There's a window, but there's one spot where the advantage is the highest. And man, if they get to that area, you're in the trade. And I don't know if you guys can see that little divergence line that it printed right there. They didn't make the midband on this trade. They made it to the fib. They never made the midband. Wouldn't it suck to have every advantage? Watch it run without you because you tried to save $5 on a trade. So guys, learn to trust this entry. And if they come get you, you're in a long position. And you're in that position with momentum from strong triggers. And you're in that position with a clear path from no terminations. And you entered precisely where the market is most likely to continue. And guys, this is how you're going to get to where you want to be as a brand new user. This is the best of the best. Not because trend trades happen all the time and they'll make you rich, but because trend trades are what are teaching you to recognize momentum. Trend trades are what are teaching you to recognize the clear path, to be able to see these advantages, to embrace them, to trust them. Trend trade is teaching you to define where the market is most likely to continue. So again, let's go through it. Reversal bar begins the pullback. It's not the entry. Define where the retracement may go from the top of the triggers to the bottom of the triggers. Believe that that's an option every time the retracement occurs. Understand that bounces come from the areas within. Activate your limit order above the top. And once you define where the market is most likely to continue, you understand where it shouldn't go. The trigger lines define the retracement zone, guys. And anything on the wrong side of the triggers, below the triggers for a long trade, your advantage is over. Your edge is gone. Rule number 3 is not in place. This is where initial stops go, not where entries are taken. So reversal bar signals the fight. Triggers define the retracement. Areas inside of triggers define where the bounce is most likely. This is your pattern on the small chart. Anything on the wrong side of the triggers is not a part of the equation. Anything on the wrong side of the triggers, you don't know if it'll stop the market. You don't know if it'll create a bounce, because honestly, you've already gone beyond the retracement zone. You've already gone beyond the bounce zone. This is no man's land, and trades taken from the wrong side of triggers lose more than they win. Understanding where the market is most likely to continue defines where the market should not go, to the other side of those triggers, generally 4 or 5 ticks. Where the market should not go is the language that's used for stops for new users. And your initial stop will go 4 to 5 ticks above all the trigger lines, below all the trigger lines. And anything that wins 70 to 80% of the time is obligated to lose 20 to 30% of the time. You'll even see pictures in that spreadsheet where people took the perfect trend trade, the highest probability trend trade, the best of the best scenario, and they still lost the trade. Guys, this is a cost of doing business. This is paying rent on your storefront. Don't get dejected if the market comes and gets you. It's going to now and then. It's a normal part of a positive equity curve. But if you're insisting on those 3 advantages, you know that if you take this trade 100 times, you're probably going to win 70 to 80 of them, and 20 to 30 of them aren't going to work out for you. So consistency is key. We're learning the patterns. This is where we put it together. We haven't talked about what it looks like when it's all done together, guys. Large chart says up. The background is green. Large chart has odds favorable momentum. Separation between everything. Large chart has the trigger lines above resistance. And the large chart is trading somewhere up here. When you're making the decision to take a trade, the large chart is all the way up here. Some of you will say, but Mark, there's just not room to get to the termination condition. It's only a termination condition if price reaches it, ladies and gentlemen. This is what we call a target. So don't skip a trade because you're 8 ticks away from a divergence high. That's your target. And it's not just 8 ticks, because remember, the rules say I'm going to buy or sell a pullback to an area inside of favorable large triggers, which means that from where you enter that trade, you've got about $300 worth of profit potential to get to that divergence high. There's that tail on the large chart. Guys, we don't trade the tail. By the time you see the tail, the market is all the way up here. We trade from areas inside of favorable large triggers. You can go back historically and circle these tails. And if they line up with areas inside of favorable large triggers, well then you have your best of the best look. Then you have your pattern, that pattern that you studied, the pattern that's been proven to win more than it loses, the pattern that reduces risk, the pattern that creates more profit potential. And that's all we've talked about for an entire hour, is being able to define your entry because of advantages. And I added this to the PowerPoint, guys. So here's a new something. Get over there. So as a new user, as a brand new user, I'm new to the software, I'm learning it. The goal is more about understanding advantages and then insisting that they're there. And this provides the highest chance of success, guys. So your job as a brand new user is to be able to identify these first and then commit to them. And that's your best chance of success. That's creating a trading plan capable of winning more than it loses while you learn to read your indicators. And you're going to start to talk to yourself. And I want you to read these advantages out loud when you see them. So if momentum isn't there, if I don't have strong triggers, your brain should automatically say, let me make sure that I have a clear path. Let me make sure that I have an entry area. Let me insist on having 66% of my advantages, because at least then I can still take a trade and manage it assertively. This is a medium probability scenario. But if you're talking about advantages, you know exactly which 2 you should be focused on to still take the trade. And if clear path is gone, you're focused on momentum and entry. And if momentum and clear path are there, but you don't have the best entry, you still may find a way to get in. But each and every one of these, when one of your advantages is gone, is this signal for you to be ready to manage, to be ready for change. And Bob mentioned that this morning. He was doing market replay. And Bob said, so on market replay, I'm cool with 66% of my advantages. I'm learning how to manage these assertively. But there's got to be a point And this is the hardest lesson, where you look at your charts and you say to yourself, gosh, 66% of what I need to take a trade that has a better chance of winning than losing is gone. And then just saying, I'm not going to do anything. I'm going to sit on my hands. An entry area isn't enough, guys. And that patience is typically the difference between winning and losing trades, especially for new users. So I added those in. Once you can talk to yourself in terms of advantages, sorry, my S&P is still loading. Once you can do that, you know what you're up against. And look at this, termination reverses the market, odds favorable, there's the tail. That tail happens to line up a tick below resistance inside of favorable large triggers. It's not even done loading. That's your pattern. Maybe somebody took it. So how do you get to where you want to be the fastest? That's my goal, is to get you where you want to be sooner than later, guys. You've got to learn the looks, and the goal is that you start on your large chart. You let the large chart lead the way. You choose not to fight the large chart. Identify momentum and path. This is the core, the foundation, the beginning. And then once you understand these two, guys, there's a lot of ways to capitalize with this software. So go take 25 pictures each of strong triggers and weak triggers. Annotate on the chart why they're each. Same with clear path and termination. Post them in your spreadsheet, guys. And I'm going to tell you right now, you can't take the time to take 25 pictures of strong triggers, to say written out, smalls below the large, space between, all red, strong triggers, momentum rule number 1. Take the time to do that. And every time you see this look, you're going to think these words. You're going to say, wow, that's an advantage. And you'll never confuse strong triggers for weak triggers. And you'll never confuse a clear path for a termination condition or the potential to break. And what happens is you start leaning. You start leaning on these advantages and you start requiring them to enter the market. And as you're brand new and you're taking those pictures, this is a high probability trend trade checklist. And it just has pictures of what it means to have the rules met. The same pictures that are in the PowerPoint that we use to teach. How to get your entries, everything. And then the second page is a checklist. And the checklist is how you're going to learn to police yourself, how you're going to be able to say to yourself, I have these advantages or I don't. And then you make the decision whether or not you want to trade. This is the high probability trend trade checklist, guys. You can print this out. I prefer that you write these rules on your chart, that you always write rules on your chart until they are so second nature that you don't need to write rules. I also appreciate that you write these rules on the chart every time you take a trade and present it in this room, because this is an educational room, and no matter what kind of trades you're taking, I'm always going to go back to these advantages on your chart. Never had anybody in the history of this checklist do worse than 70%. Print it out. See how that works for you. And then finally, there's the KISS plan, guys. I'm going to give you the KISS plan, and this is just a stepping stone for you. This is the beginning. And it's designed to optimize your chances of success as a new user using that high probability trend trade. And then through simulation, study, class feedback, continuous practice, you're going to create your own plan. And you're going to see people in this room that have their own plan. And it's not a high probability trend trade plan, and that's okay. But in this room, we're going to look at their trades and we're going to talk about advantages and disadvantages. So things you have to know before you sit down to trade and you're not on simulator. You have to understand why you'll enter. And your entry should be because your rules are met. And your rules should be a description of a pattern that's been proven to win more than it loses. So if you take one trade and you look at 10 pictures of them and none of them are the same, it's not the same trade. The advantages are different. So if you're taking the same pattern, if you have the advantages, if there is an edge, if it's been proven to win more than it loses, there's no reason to ever hesitate. It means that you don't have to know what's going to happen next. It really helps to move the emotions of trading. And then you have to know why you're going to exit. And guys, their exits are either taken at profit targets or when the advantages that you had to enter the trade have gone away prior to targets being reached, which means that speaking in terms of advantages works its way into management as well, guys. So define your entry, because great entries create manageable trades. Great entries should reduce risk. Great entries should give you the highest chance of success. And your entries, brand new users, are very methodical, very if-then, very pragmatic. Your management should be the same until chart reading becomes second nature. And what you're going to find is that if you keep it that basic, you're gonna learn to circumvent the emotions that typically show up, because management is where most of us pucker. That's where our palms get sweaty and our heart starts to race, because that little devil on your shoulder tells you that you have something to lose now. So your KISS management plan is based on 2 contracts, and it's designed to help you understand stop placement, and it's designed to get you paid, because that's the goal, guys. And so often there's this misconception among new users that every trade has to be a $1,000 trade or it's just not worth your time. Remember, 90% of your day is doing nothing. So when you do enter that market, have the highest chance of success. KISS management is 100% dependent on your ability to enter the market where the market is most likely to continue. If my entry is 2 ticks below resistance inside of triggers, then my initial stop is 4 to 5 ticks beyond the triggers. And this is cool because this is where the market should not go. Why do I say that? Because it should not go out of the retracement zone. It should not go past the areas most likely to bounce if it's going to be one of those winners. And if it does, I'm cool not being in that trade anymore, guys. And you will know your risk before the trade is ever entered. And it's up to you to decide whether or not you accept that risk. This particular trade is $150 per contract. That's your risk going into the trade from the best entry. Targets are predetermined at $100 and $200. If you don't get stopped out, it means that you got a reversal bar in the direction of your trade, and you're going to redefine where the market should not go. After a reversal bar in the direction of your trade, your new stop will be 2 ticks above that reversal bar, 2 ticks below for a long. Now you have $30 of risk per contract. You've just cut $90, no, actually $60, $240 worth of risk has gone away. And you're still not guaranteed to win. But if it doesn't win, man, $30 is a lot easier than $150, right? You still have targets at $100 and $200. If you're not stopped out, then the market went to your first target. And if it goes to your first target, one contract is automatically removed. Those funds go in your account, your palms stop sweating, your gut stop twisting, and with one contract remaining, you're going to move your stop to break even. And guys, break even isn't always the best stop. You're going to create a plan based on your ability reading the indicators. That break even stop is designed 100% to teach you to trust the large chart, to say to yourself, nothing has changed. I still have every advantage. It's screaming down, and it's more likely to go down than it is to go up. And if you don't get stopped out break even and it goes to your second target, that's a $300 trade. And I asked this question Friday. I'm going to ask it again today. Who's sitting here going, man, Mark, $300, I can't make a living off $300 a day. Anybody in the room? Because that's the initial reaction. I can't make $300. That's not enough. I have bills. Guys, this trade took 4 minutes. Actually, this trade took about 3 minutes to create a $300 win. You've got more coming. Learn how to get paid, and eventually you'll learn how to hold for bigger moves. But you've got to embrace the process that yields the results. And whoops, that's not the one I wanted to show you. $300 a day, if that's the best you do, is 75 grand a year, guys. And that's better than most of the nation does in a year. Add a break even in there and you're in 6 figures. And then it's not making the $300 today, it's making the $300 every day. Because $300 a day is $1,500 a week. Guys, that's 6 grand a month. It doesn't take a lot to start growing your account. You have to do it consistently. So know why you're going to enter, know why you're going to exit. Stick to advantages. Make good decisions. And guys, there's the all you need zip file. I just dropped it in the room. You've already gotten my spreadsheet. Inside of that zip file is this trading goals page. It's the what's it going to take to get me in and out of a trade. It's the high probability trend trade KISS plan that takes you to the 50-50 trade, your second trade. It is the management, guys. It is the checklists. It is the chart reading 101. You literally have everything you need to be successful with the software. Now it's time to get to work. Now it's time to work that repetition, to create that recognition, to ask for help if you need help. And remember, and this is for Better Dad and Trina, and who else is new in here? I know I've got some new folks. JK, you're coming in doing some studying. In the beginning, this is what it feels like, guys. There's a lot coming at you. Everything is designed to keep it very basic and simple in the beginning. You will grow a little bit every day, guys. You really will. But until you do, good to have you back, JK. Until you do, focus on advantages. Ask for feedback by telling me what you see, guys. Use that spreadsheet. Go back and study it. Keep it simple. And then you will find a way to grow outside of that plan. You will find more opportunities. So that's my first hour, every hour. And right now, it's odds favorable momentum directly into a termination condition, guys. The S&P is having challenges. Over here, we had momentum and path. What did it look like on the small chart? Well, it was a pullback directly to support inside of triggers. Do you guys see it? There's your pattern. That's your rules met. There's your trend trade. Beautiful. All the way up to Fibonacci resistance. Pretty cool, right? Back it up a little bit. I know there was one earlier today. I remember seeing it. And I want to say it was this one. Termination? No, this is just another look where it has the potential to break. Let's see what it looks like. Whoops, went right past it. What time was that? 9:49. Oh my gosh, right to support, right inside of triggers. Are you guys starting to see it? I don't have to handpick. I don't have to have pictures from last year to prove that this works. I scroll back. Momentum, potential to break. Let me go back. Right to resistance inside of triggers. So this is your pattern, brand new users. That's only the potential to break. Give it a little time. You'll keep finding ways to make money, and you'll get to the point to where you say, you know what? They reached an area. I don't want to take that trade. I don't have to be in that trade. I don't have momentum up here. I don't have to be in this trade. I've lost my momentum. Maybe anything could happen. Sure enough, it did. That's the same support as this one. But if you got tired of waiting, you're more likely to try and hope that area breaks. So, guys, and I'm going to show this one too because I think this is important. Dollars to donuts, guys. Some of you took this trade. Here's kind of the cool thing about this classroom. I don't create some illusion that that you're going to win every trade. Do you guys see odds favorable and a clear path going on right here? That was your look. If you got in at support inside of triggers, and guys, it lost. It came up, probably didn't hit your stop, and then you probably lost this trade with the best look ever. Why? But Mark, why did it lose? The rules were met. Because guys, anything that wins 70 to 80% has to lose 20 to 30. It's just a part of it. But if you got in at the mid band and your stop didn't get hit, guess what? You made $100 and went break even before it turned on you. You turned a loser into a winner. So I'm not going to do it all. I'm not going to blow any smoke. I'm going to tell you. You will lose trades. Lose the right trades. And I'm going to go take 5 minutes. I'm going to stretch my legs. When I come back, and Better Dad, this is for you a little bit, because people get bummed when I don't see their pictures first. I just posted and Mark didn't say a damn word. Just remember, I'm going to go back to pictures in order. I'll get to your pictures in the order they were presented. But if you need me to look at your pictures to give you feedback, maybe you have a doctor's appointment, maybe you have to go to work, just tell me in the room. Go, hey, Mark, could you do me a favor? At 9:45, I posted a long trade. I've got to get out of here in 5 minutes. Can I get a little feedback? The answer will always be yes. But right in this very moment, the answer is no, because I am very hydrated and I need to fix that. I will be back. Awesome, Better Dad. I love that. I will be back in about 3 or 4 minutes, guys, and then we'll get into the second half. If you have any questions, post them. If you have any pictures, post them. Go refill your water cup. This is my favorite part. My favorite part is going through and seeing what you guys are doing and seeing what you're reading and seeing just how you're interpreting. And I think it's pretty rad. Um, so every chart that I go back to, I'm going to celebrate as many victories as I'm capable of celebrating. But I'm also going to point out any challenges that are fighting advantages, because I want new users to take two things into account when you look at other people's trades. I want you to remember that they're at a different place than you, that they may take trades that don't fit that high probability trend trade, that aren't a part of that KISS plan. But what you'll see is very often when you go back to the chart read, you start to hear those advantages over and over, and you're going to realize that you're going to find yourself in a different position. So first trade of the day, didn't quite reach the area, so we're calling it a weak top. Triggers rolled down, separated, odds favorable. And here's kind of the cool thing. Is Pete drew his arrow up here at odds favorable momentum. And the reality is that this odds favorable momentum has nothing to do with these weak triggers. Nothing at all, right? So it's a great recognition. It's an awesome lesson. He knows odds favorable momentum, and he uses it for comparison purposes. And he says, hey, wait, this isn't strong triggers. This is weak triggers. The scissors are closed. And notice that right into this divergence low, divergence, 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 indecision, fluctuation. Guys, not only does Pete understand where the market may stop, he understands indicators that say it's less likely to go down than up. And here's the cool thing that he does. He says, you know what? If they can break below that trouble, if they can get below those areas creating issues, everything says down even without the momentum. His small chart did have a separation between the small and large. He says, I'll ride that momentum. I'll take that little snippet below trouble, but I'm going to get out quick because I know that it could be fleeting with these anything can happen triggers. And sure enough, it was. And notice that he gets out at the first indication of things going up. Guys, this is a great recognition that things aren't perfect, waiting for them to get better, and then being willing to manage assertively. And Pete, you did that really well. And then the market goes down and he hits the area again and he's like, oh man, stupid area. I don't have to trade into an area. I'm better than that. And the area stops printing and Pete has anything can happen triggers. It's a strong trending market, 30 bars in the same direction. And the only thing Pete doesn't have really is areas inside of triggers. So Pete says, you know what? I'm missing the areas. I'll wait for a confirmation bar. I'll wait for a reversal bar down. And he takes it and it establishes his risk. And then, of course, they come right back just to try to scare the hell out of him. But Pete's like, my stop is where the market shouldn't go. Everything is down. My path is clear. It's a strong trending market. If something changes before they hit that fib, I'll take an exit. But I'm going to give him a shot. And Pete, great management. And I think that what I really want my newer users to get out of these pictures is that when it's not perfect, be willing to get paid. Be willing to jump ship if something changes. And Pete, you did it expertly there. Nicely done. Miss Jen, termination, full reversal, odds favorable. You are into one-to-ones, Jen. So you did trade directly into yellow one-to-ones, which is a termination condition. With this level of momentum, you take what you think is a more conservative entry on the NASDAQ. I don't disagree. You get out at trouble, and this is the key. You're out at trouble. You're out at the problem areas. Probably absolutely no risk on the trade. And then just saying, man, if it doesn't break, divergence prints, I'll get the hell out. It's nicely done, Jen. It is into a termination. That's the only thing that I have to say. Remember when I said that momentum will help cover mistakes? Odds favorable from a termination. Odds favorable from a termination. She gets in on the right side of things and she manages assertively. Once again, when you know what you're up against, you can make the choice to take the trade to manage assertively. And then Bob coming in. Bob did some playback over the weekend. And I love it when you guys do playback and bring it in. So Bob, weak bottom, not a termination that reversed the market. Odds favorable, absolutely. Not a clear path, but with the potential to break. And Bob, not only is this the potential to break, that is the best momentum look ever. And I want you to see on your small chart, no divergence, strong triggers, area inside of those triggers, virtually no risk. Bob, if I were going to take a shot at an area with the potential to break, look at how small the risk is here. Look how easy it is to get to break even when you get back to the area. And if something changes, you get out without a loss. I think this is a beautiful entry. I don't think it's nearly as risky as you think it is. A divergence prints, and that's problematic, but Bob says, man, I've already got zero risk. A second divergence prints on a 50-50. Bob, that's an exit condition for sure. One divergence on a 50-50 can ruin the day. Two divergences ruins it more often than not. And this is why I asked about, would you trade like this live? Would you hold that trade live? Two divergences on a 50-50 from a weak bottom. Only you can answer the question. And Bob's response was, well, Mark, I had nothing to lose. I had nothing to lose. So worst case scenario is I'm break even. And Bob, this is that testicular fortitude that having no risk in the market affords you. And then you get up and everything is finally going perfect and you start exiting. So when I talk about would you do it like this live, Bob, you skipped the exit, didn't take profits, skipped the second exit, still didn't take profits, but once everything was odds favorable momentum screaming to the upside with nothing in the way, you chose to exit. And what this says to me as someone that's been watching people trade a long time is that you're not following a management plan, right? You don't know why you're going to exit because you're on playback. You're just hoping that shit keeps running. Pardon my French. Is that fair? And if it's not, I apologize. But your advantages were long gone. So when you guys do playback, and I'm not knocking you, Bob, and that 1700 feels good. When you guys are doing playback, one of the best things you can do is really try to stick to your plan. Because what happens is you start to see the potential that plan gives you when you follow it. Instead of breaking all your rules, having some inflated number, and then deciding that you can do that in a live market when the advantages are gone. Yeah, it helps. You don't have to. Guys, you never have to do anything I say. But I've been doing this a while. And it's the... Have you guys ever heard the phrase simulator millionaire? And then just a live market failure? Your body doesn't know the difference, Bob. Your brain doesn't know the difference between simulator and live. That's why you still get nervous in simulator trades. But what happens is you're building muscle memory. You're building muscle memory for when you go live. And that's why I think practice like you want to play becomes so important. So once again, weak top, odds favorable, potential to break. One divergence could be problematic. You choose to take it. Two divergences is detrimental. Three divergences, more often than not, will stop the market, create an untradeable bounce, and once again, you hold through all of it. Straight through. I like it. I'm not mad about it. But when you ignore exit conditions in a simulated arena, you're more likely to ignore them in a live market. And it's like luck runs out. Weak top, odds favorable, 100% clear path, beautiful entry, perfect exit. Perfect exit. Weak top, odds favorable momentum, potential to break, no divergence, perfect entry, out at trouble. One divergence on the 50-50, perfect entry. You do get the higher divergence, could be problematic. And then closed on the reversal bar. I like that you talked about the why. Can we talk about the reversal bar, Bob? And I think that this is two lessons colliding. You got nervous? All right, so let's do this. We talked about this on Friday. Let's talk about what changed. Large chart never changed, right? Odds favorable, clear path. Large chart stayed just awesome. And you enter. And you survive the retracement. And now let's talk about it. Right here is where your small triggers rolled and everything was in favor of the trade. Do you see it? That's where everything on this trade was perfect. Large down, small down, price down, trend down, every trigger red. And now you're below anything that could be problematic. And now your triggers are angled down and strong. So one of the things that I started doing, because Bob, I got nervous all the time. I was the king, especially after I went live and lost a lot. I was the king of the one tick trade. I was the king of the get in at the perfect spot, crap my pants and get out because I got nervous. That's how I know this lesson. And it's pretty common. So I adopted the phrase, what changed? Right? So what changed to make me want to get out of this trade? What advantage went away to make me want to get out of this trade? And if you start talking yourself through it while you're in the trade, what happens, Bob, is you start saying to yourself, holy crap, my small triggers got better. Egads, I'm even further away from the problem area. And it creates a little bit of courage. And one of the expectations of a trend trade is you're looking for the next fib. So management's the hard part. And let me go back and say, dude, you got paid. Who cares what happens next? You'll find another trade. You've proven that, right? You'll find another trade. You'll find another way to get in. You'll find another way to make money. Get paid. Call it a day. I took an arbitrary exit this morning. My brother gave me crap for it because that's what brothers do. But I took a trade this morning, and when I was up $500 on that trade, Bob, I just moved my stop. And I said, I don't care. It can either run or not run, but that's a $500 trade. I'm not going to give it back on a retracement. I'm not going to give it back on a pullback. I'm not going to put my stop where the market shouldn't go. They're either going to give me more than 500 or they're going to give me 500. So the goal is to get paid. You got paid. Great job. Weak bottom, odds favorable, clear path, and you jump in. No worries. And then you survive the one here. I always think it's funny, and this is funny. These are the things I notice because my brain sees things and remembers things, Bob. Is if we go back a picture, that made you nervous and you exited the perfect trend trade. It happened twice, 3 times, and you felt compelled to hold. So again, it goes back to having a management plan. And then it turns into the perfect trend trade. I love it. You're like, oh, I'm just going to hold it. It's playback, whatever. But this right here is such an awareness to be active in a trade and recognize that that's the perfect trend trade. And then once again, what changed? Nothing. Out at reversal bar. No, you got out at the hint of a reversal bar. You didn't even let it print. So now in the perfect trend trade, you're out at a half bar, but on a jump the fudge in trade, you just ignore them all the way up. It's an interesting thing. It's a psychology thing. It's easier to feel like you have something to lose than it is something to gain. And when your trading plan revolves around hope, I hope it goes up. I hope it goes up. And then right here, when you're up, you're like, man, I hope they don't take any from me. I hope I don't give anything back. And that's okay. I always love getting paid. But It's interesting when you take a step back and look at what you're doing and reevaluate. Reevaluate what you see, not what you hoped it would be in the trade, but rather what's actually happening. And someone said to me once, they're like, Mark, how come you can read charts so quickly? Bob, it's because I'm not in your long trade. I don't have any fear of losing. I don't have any skin in the game. All I'm doing is reading indicators. And if you guys get in the habit of going back and looking at what you did before, Bob, do you think you would annotate all of these charts exactly the same without the emotion of the trade still lingering? I never do. I go back and I'm like, oh man, I missed that. Or wow, that was an exit condition. I might have gotten lucky. And it doesn't mean that you're not a rock star. You're a rock star, Bob. But I think that's why giving it a second look becomes so important. It creates a huge advantage. And when you tell yourself you got lucky, it's interesting. And I do that sometimes. I'm like, I'll look at a trade, Bob, and I'll say to myself, man, I dodged a bullet here. That was the third divergence, and I thought it was the second. Or, man, I got so focused on the large chart, I didn't notice that my small chart XYZ. And I love going back. Weak top, odds favorable. 2 pulls back to the mid band inside of the retracement zone. You were drinking coffee. And the only thing about this is with the synthetics so high up, how do you define risk on a trade like this? I like the trade. Do you put it behind the 1-to-1s? Do you give it 5 or 6 ticks? When you know that the retracement zone is so big, sometimes you just have to pick an arbitrary number. Or catch it on the way down, right? Catch it on the way down. So you know that half bar exit that you took right here? Wayne does this better than anybody, and I love the way he does it. Wayne says, I really want that mid-band to hold. I'll force price to get a couple ticks above it, and then I'll catch it on the way down. And and then he just puts a stop behind the top of the bar, and he says, all right, it's not the perfect entry. They're going to have to come get me here, and I'm going to force them to go down. And I know in his trading, and you'll probably see it today, it really helps. It really helps when it's just not perfect. Force a little confirmation. Great trading though, Bob. And awesome that you spent the weekend trying to get just a little bit better. And I love this. Jen posted the picture. Termination, no triggers through, wait. And as soon as she posted it, I took a picture, and that's what the market did right after she said that she wouldn't trade it. And this is what the market did over the next 4 minutes. That's where Jen avoided a loss. And that's the indecision that happened in the market. She said no trade at 8:30. Guys, that's 6 minutes worth of NASDAQ from termination to termination to termination to termination to termination. I love taking pictures when the rules aren't met because it reminds you. It reminds you that the rules are your lifeline, that the rules are going to keep you out of more losers than winners. Great picture. All right, Wayne. Weak bottom, odds favorable, clear path. So we're looking at the trend trade. It's awesome. Strong triggers, nothing in the way. Pull back to support right inside of the retracement zone. Easy money, and you're out for 100. Love it. Profit target 1, and I'm guessing you went break even. What a great looking trend trade. Large chart said go. Small chart defined the entry. Wayne's job is to get paid, and you did it awesome, Wayne. And then this is one that Wayne takes. More than break even. Oh, there it is. Trailing 3 bars behind price. Like it. This is what Wayne calls the heartburn trade, guys. And we're going to look at it from 2 different angles. The first way we're going to look at it is odds favorable momentum down. Trend down. Strong triggers down. Strong triggers down. Everything says down. And Wayne takes a trade going the other direction, trying to predict that retracement back to a potential trend trade. I like it. Wayne, you broke your rules though. You never made it to the outer band. your entry typically comes right off the outer band. So even though this isn't a high probability trend trade, I know Wayne's pattern. And it doesn't look like you hit it. First box made, see? And Wayne's always got a reason, so there you go. I don't see how it could because this is a moving average. That's okay though. So Wayne's rules met. Wayne takes quick profits. And I think that the thing is when you know what you're up against, you manage assertively. Wayne doesn't hold and hope. I don't know what that means. Box takes up a little more room. So for new users, this fights everything on God's green earth. Takes up more room than the... I'm not following, but that's okay. It's your trade. Fights everything, without a doubt. And you found a way to make it work. And I love it. I love it for you. If you're a brand new user, this trade is going to lose more than it wins. And fighting the trend is rarely the easiest path. But different strokes for different folks, guys. Grandpa always said if we all liked the same thing, everybody'd be chasing grandma. All right, Miss Trina, high probability with kiss. Weak top because the triggers break. Perfect read. Odds favorable momentum because triggers wide like scissors. Amen. Clear path to term. Now look small chart for entry. This is the greatest annotated chart ever. Reversal bar starts the pullback. Sell entry 2 ticks below the line inside of triggers. Initial stop 5 ticks above. Move stop 2 ticks above highest price. Oh, it just missed your 100. Reached the target but didn't fill. Trade failed, the Ninja Trader crashed, so no picture. Oh, man. That was so close. Great trade, though, Trina. And good job just following a simple plan in the beginning while you learn to read these indicators. That's awesome. Nicely done. And then that was Wayne's. I think we had another one for you, Trina. There it is. You're doing great. High probability trend trade, more than 30 bars means odds favorable momentum with that railroad track look. Absolutely. So you say rule number 1 is met. Rule number 2 is not. Line inside of favorable large triggers. Kiss plan, target 1, target 2, initial stop 2 ticks above highest price tail. All right, so Trina, not a high probability trend trade. We're going to talk about a couple things. I like the trade, but we run into a couple things. If your reversal bar starts the pullback, right? Right on. So Wayne's got a different plan than you. So remember, just because I say it's not a high probability trend trade doesn't mean that it's not a good looking trade. It just means that it's not a high probability trend trade. Your large chart read is perfect. Strong trending, guaranteed odds favorable, clear path. The challenge that you have on this one, Trina, is this is your reversal bar, right? And it's not odds favorable on the small chart because your small triggers are inside of the large triggers. Does that make sense? Just because it was odds favorable back here doesn't mean that it's odds favorable here. And the small chart will show change. So what happens is this is your reversal bar, and there's where it prints. And I just want to use some of the entry language here. Railroad is a large chart thing, Wayne. Railroad is strong trending market. Momentum is defined on the large chart. Small chart shows change. Yeah, so that's awesome. I like the comment. So what happens, Trina, is that if this is your reversal bar is already past any areas inside, right? So that area is not creating a bounce. Your reversal bar went to the other side of it. How could that be a part of the equation? So rule number 3, what you have is no rule number 3 met. And that's okay. That's not a killer. So if rule 3 is not met, it's okay to insist on a little confirmation. And let me show you how you could have gotten in this one even sooner, because the large chart's perfect. Once this reversal bar prints, risk is established. Does that make sense? So you could enter with the confirmation bar, and what it does is it gives you room. Whoops. It gives you room to get back to that area that created a bounce. And it's a lot less risk. Does that make sense? I hope so. All right, so your perfect entry is the area inside of triggers, right? And if the area is not inside of triggers, well, then it can't be perfect. And one of the things that I love to say, and a lot of people are finding success with this, if my entry isn't perfect, I'll force it to give me a reversal bar and use that for entry and stop placement. Because then it's not arbitrary numbers, because your large chart still said down, and your large chart still said everything is screaming, and your large chart still had nothing in the way. What you're doing is you're just trying to figure out how to get in. And that confirmation bar is a great way to get in because it establishes your risk. So instead of having that huge risk, you've got a little less. And remember that trends end, right? This is going to go away eventually. If you get multiple divergences, if things start to change over here, that small chart, well, I'm saying if you're going to break rule number 3 because your areas are on the wrong side of triggers, Trina, is there any reason the market couldn't have retraced up to this fib? Is there any reason once you're on this side of them, it couldn't have gone all the way up to the mid-band and turned into a trend trade? Once I'm on the wrong side of these triggers, I don't know how far up it's going to go. I don't know if it's going to be a mid-band, if it's going to be a fib, if it's going to be a large chart mid-band. Hell, I don't know if there's going to be a reversal. So what I can do is I can say, all right, large chart looks great. Let me see. This is a great example. Large chart looks great. Small chart doesn't have an area inside of triggers. Does that make sense, Trina? Large chart's awesome. Small chart entry rules aren't met. If I'm going to hope a mid-band holds, at least this confirmation bar gives me a place to lose when it fails. Instead of, because 4 to 5 ticks is at the mid-band. So it doesn't guarantee a winner, but at least it establishes a stop. But once you get below these triggers, I don't know. Is it going to be the mid-band? Is it going to be these 1-to-1s? Is it going to be that fib? Oh my gosh, look at that. Is it going to be that mid-band? Is it going to be that next fib? Hell, it's going to be none of them. That's why rule number 3 is areas inside of triggers, because you're defining the retracement zone. And the areas inside are where you have the highest chance of success. So if you're going to forego rule number 3, you can at least insist on confirmation. And getting 1 tick below these 1-to-1s, I like it. Trina, price hasn't gotten anywhere near the other side of these. So the large chart was awesome. But if you really want to get past the area that could create the bounce and mess up your good time, let the back of the bar get below trouble. And I think Wayne had, or Pete had one like that. Let the back of the bar get below that divergence, get past everything that could create the bounce. And then the same thing. But the KISS plan is a plan for the high probability trend trade. This would be a momentum trade. And if that momentum subsides, that's where your advantage goes. Great picture. Good lesson in there. If my entry isn't perfect, perhaps I'll insist on a confirmation bar. And that's a decision that you guys can make for yourselves. You guys can decide if that's what you want to do with it. All right, Wayne, let's see what we got. Whoops. Hold on, I messed up. There we go. We already saw that one. That's a repost. And then just waiting for the smalls to get on the correct side of the large triggers. I love it. Wayne says, check it out. My rules aren't quite met, so I'm going to sit still for a second. I'm going to do nothing. I'm going to wait for the advantage. It costs less to take the picture than it does to take the loser. Patience is such a part of what we do. Miss Jen, not a strong bottom, odds favorable, and there's her thing, no divergence. Price comes back to the entry, she lets it get to the other side of price and makes money right up to trouble. Great trade. Nice trade, Jen. Guys, one of the things about the NASDAQ is if you fight these small triggers, it's hard to win. If you get in with all of these advantages on the correct side of the triggers, it's a much easier trip to get to the end. Jen, great job on that one. And then Trina, this is Wayne doing a lot of what you talk about. See how he says back of the bar clears trouble? Let me expand on that because he's doing it awesome here. Back of the bar clears trouble. So what he's saying is let me get price away from the decision-making zone. And with all of this momentum, 3 charts worth, let me make money. It's only momentum. Let me get the hell out. And then with all of this, price gets below, triggers are all down, the path is clear. Wayne says, man, this area could stop the market, could create a bounce down, but I'm not sold on it. Let me force them to confirm. And there's every lesson we just talked about on this chart. Strong trending, path is clear, not a perfect entry. Wayne says, I'm going to force them to go in the direction of my trade. And Wayne, it gives you room to get back to potential trouble. Awesome job on that one. I like it. And it works out. He gets in, he's got room to trouble, and he just rides it down to the next fib. Rockstar. 30 plus bars, odds favorable, clear path. Room for 180 to get to trouble. And I love it. Insisting on confirmation because the entry isn't perfect. But you have to know what perfect is, right? If you're going to insist that on confirmation, you have to know what perfect is. Fail with the best look and rules met. And I get it. This is one of those trades. Wayne, can I give you something to think about on this one? When everything is screaming up, if you're that close to a fib, if you were in a trend trade, where is that trend trade most likely to go? To the fib, right? That's kind of the expectation. I think if you're that close to a fib, it might be a pump the brakes moment. And then let something slow down. Let something slow down a little bit when you're this close. Because they love these fibs, man. And you're only like 2 or 3, 4 ticks off of it, but not so close that you're like, okay, that's close enough. So with odds favorable on 3 charts, everything screaming up, and a termination looming so close, I don't know. That's just something I was thinking about over the weekend. Because it seems to be, and I'll show you what got me thinking about it, was this picture. Nope, it wasn't that picture. Hold on. Which one was it? It was this picture. This is what set off the thought process. With everything this strong, yeah, it went to the... So when everything is this strong, right? This strong, this one fails, this one doesn't make it, and then finally when triggers roll, the divergences start printing, it seems to make it, right? So it went up and hit the fib, and then it went to the small chart midband. So you just kind of verified what I just said. When it's this close to the fib, maybe forego the loser and force it to hit. Because then at least you have a termination condition supporting you. And again, your trade, you can do it your way. I know, but your stop is right where the market is likely to go. That's what I'm saying. Is if I were in a trend trade, if I were long, that fib would be my target, which means that your stop is right at everybody else's target, which makes it, all right, okay means shut up, I don't want to hear anymore. So let's go to the next picture. Miss Jen, we saw that one. Did I get these? Yeah, those were all beautiful. Jen. Right on. Thank you, Wayne. Divergence, not a term. Language, right? What's a termination? Price reaches an area. The triggers remain below. This is for new users. Jen, you just set up a lesson for the new users. Whoops. Oh. That's okay. But a lot of people are going to say, what does he mean just divergence? Isn't that a termination condition? So this divergence line prints about right here, halfway down on the second bar. So this is one of those things where price didn't necessarily reach divergence and reverse the market. Price actually created that divergence. So for a divergence line to be a termination, price has to come back and retest it and then head down. And that's just, it's like a line in the sand. So this is just a loss of momentum, but everything reverses and you have odds favorable and the potential's there to break and there's no divergence. And Jen, that's one of those ones where it was so close. So you get in on the correct side of the triggers. And with this look, it's pretty easy money all the way down. So that really didn't change anything so much, except that in your rules, if it has to be from a strong top, it gave you the ability to take this trade. But you had every advantage, conservative entry, and it was so easy to make your money on the way down. Nicely done. And that's just a language thing. The difference between divergence and a termination condition. All right, better dad. So looking for a long trade here. All right. Better dad, we have a lot of lessons here and a lot of good ones. So we're going to do this. So the 3 rules for the high probability trend. No, I'm telling you, this is great. And the fact that you're posting is awesome. So a common misconception because of this high probability trend trade checklist, let me open that back up, is that a strong top or bottom is rule number 1. A strong top or bottom, better dad, adds some warm fuzzies to it, but your rules are strong triggers, clear path, and entry area. Does that make sense? And then if you have a strong top or bottom, it kind of makes you feel even better about it. All right, so not quite a strong bottom. Divergence is awesome. And let's talk about the difference between pivot stop out or divergence acting as a termination and an actual termination. So, and I'll put this in the room for everybody. And Bob, this is so common, or better dad, I don't know why I called you Bob, sorry. Better dad, this is so common that I wrote a little thing on it. So a little terminology, and this will help new users. A pivot is just a place where the market changes direction. Pivots happen all day long, guys. It goes up, it goes down. Doesn't necessarily mean it's going to go down forever, up forever, but it's just a pivot. If there is a loss of momentum at that pivot, and I love, Wayne annotated it the other day, sellers said no. Buyers were in control, sellers said no. They stole the momentum. You get that magenta line. Sellers were in control, buyers said no. I'm going to have to send you a nickel, Wayne. That's what creates the divergence line, and it happens about 2 bars up, 2 bars down. So price never reaches that line. Price actually creates that line when there's a loss of momentum. That line becomes a termination when price reaches it. And when price reaches a line, that divergence high in this case, and the triggers remain below, now it's a termination. And that creates that pivot stop out. If price goes above it, then back below, this pivot stop out's powerful, especially at Fibonacci. So first it's a pivot. Hell, Wayne, as many lessons as you've given this room, I'll send you a Starbucks gift card. Divergence creates here, it's off the low, not a termination, but when price reaches divergence and the triggers remain above, now it's a termination. And if it goes below and back above, that's what we call the pivot stop out. And that's a pretty powerful one. So when we get back to your picture, did that make sense better, Dad? And there's a great example of it right there. When price comes back and retests it, that's your termination. Here, it's only a loss of momentum. But let's go through it. So, odds favorable momentum. We're going to go back to the very basic lessons. In order to have odds favorable momentum on the large chart or the small chart, either one, there is one look. And that look to the upside is that the small triggers are above the large triggers, but the large triggers are wide, they're green, they're angled in the direction of the trend. Can you guys give me a why if that makes sense? Scissors open, both blades, right, are wide, angled in the direction of the trend. So better dad, it's trying, but it hasn't quite gotten there. Yeah, not yet. That's okay. And then I love this. Clear path? Nope. I was just excited. Amen. Been there, done that, man. And that's exactly what that is. Price reached the area and the triggers remain below. And that's your, let me sit on my hands and do nothing. And then just to add to it, do you see how far away those triggers remained? And price pulled right back to them. That's that gap theory again. Got excited to see the software? Yeah, man, I love it. Post every one of these, better dad. And I'm telling you, there's going to be a lot of them in the beginning. And they'll start to work their way out of your trading. Because what you're doing right now is you're talking about the advantages. And God bless you, you're talking about the advantages. And if that's your commitment, mess it up every time. It's cool, no worries. Because you'll learn how to avoid it. So not quite momentum, not a clear path, not an area inside of triggers, and punished, yup. Learn something, yup. I love it. This is kind of like when you go to the gym, you don't grow muscle unless you break down the muscle. Failure is the word that we use in the gym. Work to failure and you'll come back stronger. And better dad, this is gorgeous. Can I give you my 2 cents? You've got market flow overlay on your entry chart, which is more than you need to look at. If you go to your small chart and right click and go to templates, there is a 5-1 Renko bar chart. Let me put the picture in there. So you are going to right click on small charts, go to templates, load, and then if you put this one in, the Nexgen dynamic 5-1 Renko bar, come on, I'm crashing, nope, there we go. Right there, the 5-1. That's going to take all the noise off of your chart. right now, you've got what's called a market flow overlay, which means as a brand new user, you're looking at high volume area lines, you're looking at high volume areas, and there's a lot on there just to distract your eyes and take you away from what's important. So you don't have to do it, but I think that it simplifies the process a little bit. It is busy. When my brother started doing this and started showing this to people, I put it on my charts and I took it off almost instantly. I'm super artsy fartsy and I recognize patterns, and things that distract from my patterns become problematic for me. So again, you don't have to take it off, but I sure think it's easier for new users if you don't have it on there. Great chart though. Keep them coming. We will talk about everything you post in this room and come back to it and build lessons. And I think that's what makes the room great. So market has a strong trending market. CAV is trading directly into a termination condition. He says it's strong trending. If this thing's going to keep going up, there it is again. I'm going to force it. No, he didn't. He just jumped in arbitrarily at a fib. And he got it. So, strong trending market. There's this idea that you keep buying mid bands until it doesn't work. Cav, the only thing you skipped is you're really not supposed to do it into a termination condition because this could happen. So did you dodge a bullet? Maybe, but you had a lot of support. This is the bar fight scenario. And let me show you what Cav did. Cav said, and I'm putting words in Cav's mouth. Cav said, my trend is up, my smalls are up, my large are up. If it comes to support, all the triggers are above it, it's a termination condition. My smalls are up, my large are up, my synthetics are up, my trend is up. This is my trouble. Right there. So guys, if you were making a decision on whether or not you wanted to risk a little money, do you see how Cav's able to let his chart reading say, all right, we'll get in at the fib? And I know Cav probably said, man, if it gets 4 or 5 ticks below that fib, I'm going to jump ship. I'm going to feel like I don't know where that thing may stop. And notice that his exit is right up there by trouble. So is it high probability? Absolutely not. Is it weighing out advantages, choosing to take an entry? Absolutely it is, guys. And that's where everybody's headed. And it's just whether or not you feel like you have the advantages you need. And when you talk it out, only you can decide if it's right for you. Does that make sense, Cav? Guys, it's not my job to go, damn it, Cav, you traded into a termination condition. It's my job to take the chart read, to look at the indicators. And once you start knowing what you're up against, you know where the problem is. I'm going to yell all day long, grrr, because I'm angry. It's what I do. I can find the good in anything, guys. I really can. But I'm not afraid to point out the negatives because identifying the negatives lets you really focus on the positives. It's works out. All right, Steve Diego. Odds favorable momentum. Not a clear path. Odds favorable momentum. And I want you to see something cool, guys. He lets the small triggers get above, price get above. And he says, with all of this momentum, the potential is there to break. I'm going to bank on that potential to break this area, and I'll enter right at the fib on a little stab back to the fib. And this is the Nexgen momentum trade. And guys, all it is momentum. So he takes quick profits and gets out. Steve, this is done beautifully. Maybe just a little premature because the smalls didn't break, and that's one of the rules. But price did. Price broke and snapped back. So again, weighing out advantages, deciding whether or not it's worth your money to take the trade. Steve, you did it great. Morgan says he thinks he got lucky with the first one. Ha ha ha. Cav, have a good one, man. All right, so let's see what we have. The first one. Market cleared trouble, was fast moving, so you went for the chili dog down. So the only thing I'm going to ask, Morgan, is did you have momentum? No. So it can't be a momentum trade, right? So what is it? Where's it coming from? Was it coming from a strong top? Was it a strong trending market? Right? So there's a lot of information that might make us feel better about this trade that isn't shown. But it was coming from a termination that reversed the market. Was it 30 bars in the same direction? I love you for that. But if this is a strong trending market, and it looks like it was, you can say, all right, with a clear path, it's going to take something to stop this. So jumping in here and out at trouble, there's nothing wrong with that. You took a shot based on advantages. You didn't even let it get to trouble. You said, this is just a quick one. Let me get in, let me get out. Then the termination, then the reversal. Everything says up, and you didn't catch it on the way down. So you catch it on the way up. And instead of getting out at 32 flavors of trouble, you give everything back directly into Fibonacci, directly into one-to-ones, directly into a mid-band. So the only challenge here, Morgan, is that your patience was great, your advantages were awesome, your momentum was incredible. You just refused to get paid. You had all the stop signs in the world. And your brain told you, yeah, that's a strong trending market. Morgan, that was a great short. But do you see how that, you had a fib, you had a mid-band, you had one-to-ones, hell, you even had divergence. Morgan, the only thing that could have given you more indication that that was a good spot for profits is if I walked into your room, sat down next to you and said, hey, Morgan, that's where the market is likely to go. You're good enough to find the next one. Does that make sense? The willingness to get paid. The willingness to get paid. You guys are so good at this. You're gonna find the next trade, guys. You have to believe that. You have to believe Morgan, you are so capable of finding the next trade. The goal is to make money. All right, Iron Mike. Odds favorable. All triggers above the yellow one-to-one. So odds favorable and clear path. Perfect look. Split triggers, not the best. And then there you go. See if the second one runs, right? And it didn't. That's okay. You didn't lose, Morgan. So you made a calculated risk. You took a calculated chance. It just didn't work out for you that time. Sometimes they break and run forever. So, Iron Mike, were you in here for the lesson on when the area is not inside of triggers, you just don't know? Once you get to the wrong side of the triggers, you just don't know. And because you're doing that market flow overlay, you probably missed a reversal bar in there. So you get in arbitrarily. Where was your stop? And why below the bouncy thing instead of above it? That's what I don't get. Mike, if we're playing catch, right? And I'm throwing the ball to you, and you're throwing the ball to me, are you ever going to stand on the other side of that wall to try and catch it? No. Why are you trying to enter from the other side of what you hope creates the bounce? Because you don't have any place to put your stop. It's not like it reduced risk. Does that make sense? Not beating you up for it. But if you're hoping that midband creates the bounce, doesn't it make sense to get in above the midband instead of below it? That's all I'm saying. You don't even have to answer. Because once you're on the wrong side of the triggers, it could be here, it could be here, it could be here, and it turns out it was none of them. That's why rule number 3 is area inside of triggers. Kind of cool, right? There's your visual. And you knew that you were up against it, so you managed aggressively. And I love seeing that on a chart. I know it's not perfect, I'll manage aggressively. And I don't know if that's aggressive management as much as it is, maybe I shouldn't be in this trade. Because 4 ticks isn't aggressive management. You didn't give it a chance to trade. Like you didn't give it the opportunity to even change a little bit. You just said, this might not be right. Let me get the hell out. I'll wait for the better one. Which is, I think, awesome. Anytime you can make, in quotes, didn't have time to move the stop to the right place. Okay. So 12 below. 12 below what? The entry? Okay. So here, there's a misconception about that number 12. Some people think that 12 tick stop, that's your stop, right? If I enter here, my stop is at 12 ticks, and that's going to magically keep me safe. So that 12 tick stop is designed to give you reaction time, to put your stop where the market should not go. Does that make sense? So initially, it's up here. It might be 12, it might be 14, it might be 25, depending on the trigger look. Right on. Then you adjust it accordingly. So where would you adjust it to on this entry? Would it just sit at 12? And that's where I'm getting with this, Mike, is if you're already where the market should not go, how do you define your stop? So you put it right at the fib that may create the bounce. Okay. These things just interest me. I think it's interesting. I like it. So once you got the up bar, then you have a place to put your stop behind it, right? Is it worth it when you're on the wrong side of the triggers to wait for the up bar? That's a lot less risk. Just stuff to think about. And guys, when I go through this, I'm trying to get you guys to think about it. I think language is important. And if I can't define where the market should not go, it becomes more difficult for me in stop placement. And then I really do. I just have to pick a number. And when I pick a number, what am I willing to lose? Well, Mike, with this look on the large chart, my number's probably $100 a contract, and I'm pretty good with that. Right? But it is just an arbitrary number. I like it. Good picture. Dima, I saw you just posted. I think I might have missed one of yours earlier. Let me double check. I'm scrolling through, guys. Pardon the silence. Sometimes I see a picture and then... Did you delete one, Dima? Oh, okay, cool. Oh, you don't have to remove it. You don't have to remove it. We're almost to you, though. We're almost to the bottom here. And Mike, I like the long, by the way. I know it doesn't matter if I like it or not. Trina, take care. But I like the large chart led the way, and I think that's so important. All right. Better dad. Almost to the 1-to-1, so weak. Perfect. Odds favorable. Perfect. Waited for market to get above fib, but bars didn't clear. So watch this. Let's go through the language one more time. So better dad, the recipe for a termination condition is always the same. And I'm going to go, let me get a picture real quick. And it's kind of cool. We'll use this picture. So when price reaches the area, and this is for everybody, not just better dad. When price reaches the area, I'm done with price. Price has done its job. It's gotten the sellers to the decision-making point. And then once price reaches it, it's 100% trigger lines that tell the story, 100%. So at first, it's a no trade termination, then it's the potential, and then it clears if that area is going to break. And what you have right here is an awesome example of an area with the potential to break. No, better dad, there's one thing you're going to realize is that anything you can do with this software, the people that are 6 months ahead of you have already done, and they're not rolling their eyes. What they're doing is they're going, man, I remember this lesson. I remember this mistake. I remember posting this picture. I remember the lesson that I got so that I could avoid this one. Show of hands. Who messed up termination conditions at some point before they figured it out? There's mine. I was the king of not understanding termination conditions. Better dad, what you'll realize that you are in the best company ever here. Because we've all done it. And we've all had to go through the lessons. So yeah, no digital eye rolls, I promise. And let's go through the entry rules. And you're going to see just how great this trade actually was. So check it out. You had odds favorable momentum. Love it. Rule number 1, beautiful. You had the potential to break because of that momentum. Beautiful. So what we have here is a medium probability trend trade, which means that the path isn't clear. Let's look at the small chart. And this is the best look ever. You have no divergence. So let's go through rule number 3. Dun, dun, dun. At the time of the reversal bar, I'm going to define, excuse me. At the time of the reversal bar, I'm going to define where the retracement is most likely to occur. So, better dad, somewhere from the top of the triggers to the bottom of the triggers. This is where the retracement is most likely to occur. So we'll get rid of that. And then it's most likely to bounce from an area inside of that range. Does that make sense? All of us, Steve. It's the most broken rule. So you got in at the highest point of support right inside of those triggers. It went all the way to the lowest point. That happens sometimes. But it stayed in your range. It stayed in your window. Nothing changed. It just pushed to the bottom and then it went right back up and you did it. So better dad, you had momentum. You had the potential to break. You had no divergence and strong triggers. You took an entry that makes sense. It just happened to go to the very bottom before it headed back up. And then you got out right before that divergence high. Dude, rock star, better dad. Does that all make sense? And that's why the rules are so specific on rule number 3, from areas inside. And it's a window from the highest to the lowest. Yeah, dude, you're going to be nervous for the next year. So what you can do to help ease those nerves, and here's a great example. Whoa, that's not what I wanted to do. I've never done that before. That was kind of cool. So better dad, strong triggers, potential to break, Pulled right back to support inside of triggers, didn't it? Finished the move. So how do you get less nervous? Go back and study these looks. Go back and circle these tails. Odds favorable. Potential to break. Hold on. Where's that circle? That was at 1057. Holy crap. Pull back to resistance inside of triggers. And I'm telling you, you should be nervous as a new user. This is exciting. But once you learn this look, you begin to trust this look. And once you begin to trust this look, Better Dad, you start putting your stop right here and you start saying things like arrogant. These guys have to come get me. I'm not getting out with a perfect look because you study it, you practiced it. And what you did on that last trade is the reason why stops go outside of the trigger lines. Beautiful trade, dude. Amazing trade. Welcome to Nexgen. Now it's just rinse and repeat until it becomes easy. Andy Man, you're welcome. Okay, I was like, did he reverse it? You didn't. Large chart, strong triggers, clear path, pull back to support on the wrong side of the triggers. That's okay. Andy says when the large chart's odds favorable and clear, I got a shot. I'll get in here and I'll ride it up to there. Nice trade, Andy. Did Andy run the risk of getting run over, getting in on the wrong side of triggers? Of course he did. Andy knows that. He liked his advantages. All right, Lou Dog. Pivot, stop out. Strong triggers. So Lou, I love to see your small chart too, brother. Because I want to see your entry. I really do. So let's talk about the pivot stop out. Yeah, no worries. That's okay. On this one, don't worry about it. So here's your pivot, right? And you're saying, there's my pivot stop out. I like it. There's one thing I want to point out. It's no longer a pivot stop out because small and large got below that divergence low. So what you actually did, Lou Dog, is you broke the area. You created a clear path to the next area. And then those weak triggers is where the reversal came. So not a strong bottom. Does that make sense, everybody? Once the small and large got below that divergence, its ability to be a strong bottom stopped. Anybody? Nobody? Doesn't change the fact that you had odds favorable momentum. Doesn't change the fact that you had the potential to break. And it looks like you got to the area inside of those triggers and took the long. So nicely done. So the one-to-ones gets another great lesson. So check this out, Lou Dog. You're going to like this. I hope. So this is how fibs are born, if you will. Fibs are the result of tens of thousands of calculations, of measurements, of retracements, of alternates, of weighing and sorting and picking the highest concentration level. So anytime I talk about a fib, I want you to think, all right, 2 ticks above, 2 ticks below. It's an area. Does that make sense, everybody? All of these calculations create a blue line, create a red line. That's how fibs are born. But one-to-ones, these are exact numbers. The same way divergences are exact numbers. So if I'm 2 ticks off a fib, I'll call that a termination condition. If I'm 2 ticks off a one-to-one, they didn't hit their exact number. So it was close, but not quite. One-to-ones and divergences are exact numbers. Fibs are areas. But it didn't reach the fib, so not a termination. Odds favorable, potential to break, and it looks like you got in probably from the bottom of the range. And I don't even know what market this is because I can't see prices. So if you want to post your entry, that'd be awesome. But it looks like you did what you needed to do to have those advantages in play. Morgan, we already saw that one. Dima. All right. So your entry was at the bottom of the window. Beautiful support inside of triggers. The only support inside of triggers. Lou Dog. It's perfect, dude. Look at that sniper entry. Inside of triggers, stop where the market shouldn't go. I mean, that's beautiful. And then no divergence on the 50-50. Come on. Gorgeous. Gorgeous. Nicely done, Lou. And man, when it's the right trade, that thing rockets, doesn't it? Beautiful. Easy 5.5 points. $200. That's 50 grand a year if that's all you do every day. So solid. Shoulda, woulda, coulda, right? You made money, right, Lou Dog? If I handed you $1 or $100 and you walked off, when you got to where you were going, were you like, damn it, I should have hung out to see if he wanted to give me another 100? No, you'd be happy about it. Learn how to be happy with profits. Yep, never go broke taking profits. Dima, putting on a clinic. Odds favorable, clear path, perfect entry. It's right below the mid-band. Gets paid at trouble. Exited with second divergence, but decided to get back in. Great heads up, Dima. And then took it down to Fibonacci support because that's the expectation of a high probability trend trade. The only thing I can say about this, Dima, is there was no reason to get out, was there? Not with this look. There was no reason to take that second exit. Hell, just put that contract back on the high probability trend trade, run them down. So why was your stop there? And I'll stick to my guns. No reason to put a stop there. Because Dima, watch this. So let's go to the second trade. On the second trade, did you have odds favorable momentum? Yes. Did you have a clear path? Yes. Whoops. This is the rules met 100% for the high probability trend trade, right? Do you see it? And Dima, this is what happens when you grow with the software. You start to think this way. What does that mean? That means that if I get a reversal bar, I need to enter at an area inside of triggers. That's rule number 3. Is everybody with me so far? Do you see how you put your stop right where you expected the market to go? Right 4 ticks below where you should be entering. And we've all done this a million times, Dima. So you'll get to a point where you'll say, man, this arbitrary BS number has nothing to do with an exit. I'm just going to wait for the entry. Maybe I'll put this contract back on because it's so good. I've already been paid on it. Or I'll just hold to the fib because it takes 3 divergences to kill this look. Does that make sense? I've done that more times than I care to share with the room. So, and I know exactly what happened is you got paid and you were up money and you said, you know what? I'm going to put a stop in the middle of nowhere because I don't want to give it back, right? Not knocking you still got paid and you had the heads up to get back in. There you go. That's fair. Trailing it without thinking where to set it. And that's where that language comes in, where the market should not go. That's where that language pays dividends. Because if you're going to hold That's where the stop goes. Otherwise, just GTFO and take the re-entry. The next entry is always coming. And if this had gone up, you would have said, oh man, I'm so glad I took profits. But with this look, it's more likely to go down than in. I love that you got the next entrance though. I hope that made sense. Not putting stops where the market should go, putting them where they shouldn't go. Great stuff. All right, weak bottom, not essential. Odds favorable, absolutely. Potential to break is there. The only thing that you don't have, all right, better dad, areas inside of triggers. You don't have an area here. Your stop makes sense. The only thing that you don't have is an area. Does that make sense? It's not pulled back to the triggers, and this is language. This is why we say the same thing over and over and over and over again. So the entry, let me find it. Hold on. Your window is the areas inside of triggers, not the triggers, but the areas inside of triggers. So the triggers will define where the retracement is most likely to go. The areas inside define where it's most likely to bounce. Does that make sense? So when we look at your picture, once these areas inside of triggers don't create a bounce, I'm not sold on this because there's nothing bouncy. It's just triggers. And sure enough, it does continue down. So once these didn't hold it, I'm pretty much done looking for the trade. No, it doesn't. It looks like an awesome shot at a long trade to trade with momentum and the potential to break. So let's change the way we look at things. It's not a poor trade. It's a beginner's trade as you learn the language. And this is one of the reasons why every time I show this picture, whoops, where'd it go? Every time I show the picture about the window of opportunity, I try to remember to capitalize inside. I try to capitalize the word inside of triggers because that's where the highest advantage comes from. So in your particular trade, with this look coming from the bottom, everything up, all that momentum, you might say to yourself, dang it, there's not an area here, but if I get a reversal bar up with this look, maybe I'll take a shot at it. Does that make sense? So brand new users, once we get below these, it's out of the equation. Experienced users, they might wait for a reversal bar or something because the large chart was perfect. I like it. I think that you're letting the large chart lead the way, and I think that is going to pay dividends long term for you. And remember, that's exactly what sim is. Sim is, it's the batting cages. It's the driving range, right? You can't strike out at the batting cages. You can have 173 strikes. And then you learn, oh man, keep that elbow tucked, step into it, dig off the back foot. You're learning all the lessons in a zero risk environment so that when it's time to risk, you've got a little muscle memory. So don't ever knock yourself for making mistakes. Mistakes are where you learn. Steve Diego, strong top, odds favorable, potential to break, pull back to an area inside of triggers, 2 contracts off at 200. I love it. Getting paid. That's the pattern. Steve, it's almost weird seeing you take a trend trade. You've been momentum trading so much lately. Can I ask why you didn't try the momentum trade? Maybe you weren't there for it. But I love this. Beautiful. Missed it? Right on. It's just weird. Usually that's yours. It worked out this time. Sometimes you're the boot, sometimes you're the butt. I love it. It's the perfect trend trade. And you're using your momentum trade management though. That would be the only thing I could say is you're using momentum trade management for a trend trade. I love one contract where the market could bounce, and then since I'm anticipating, hoping this area breaks, I'm looking off in the distance. I'm looking for those further spots, maybe make a little more money because it is a trend trade, not a momentum trade. Does that make sense? Or you may just take everything off at 200 too, so that's okay too. Never give trading advice, but when I see stuff, I like to talk about it. All right, guys, that's all the pictures. What's the live market doing? All right, so let's do a read. Let's just go by the rules. So, better dad. Trina's already gone. Who else is relatively new in here? Every time I look for a trend trade, I go through this checklist, and I say it out loud, guys. My dog understands odds favorable momentum. So I'm going to draw an arrow to the most current bar. And I'm just going to ask myself the question. Do I have strong triggers? What do you guys think? Better dad? You seeing strength there? Mike says no. Bob says no. Boaz says no. And Boaz, I think I missed one of your pictures. So perfect. Does it mean that there's not a potential trade? No. What does it mean? It means that I don't have momentum. All right. But I'm not ready to quit. I'm not ready to give up. Do I have a clear path? Did my smalls and large get below all the areas? Did I reach the next area? Do you guys see this? So, yeah. So this is where my brain says, I've got half of what I need on the large chart. You know what? If the small chart gives me the perfect entry, I'll take a shot and I'll manage it aggressively. So let's take a look. There's 1, 2, 3 divergences in the same price range. Oop, clear path should have been yes. I messed that up. Thank you. Does everyone remember 3 divergences in the same price range is a term? No clear path. There's my tiebreaker. I'm not going short. I don't have what I need on the small chart to even look for an entry. What if it was the perfect entry though, right? And it's not. All of these areas are on the wrong side of triggers, right? The large are up, the synthetics are down. It's ugly over here. So if I were thinking about taking a shot, hold on, where's that picture? I did these this morning. I don't have momentum, so I better have clear path and an entry area. I had a clear path, I didn't have an entry area, so I chose to not take the trade. Do you guys see how when you talk about the advantages, it helps you make better decisions, and it doesn't mean that it won't go down, but it may change as it goes down. So I thought that was pretty cool. The whole idea that when you talk about advantages, Boaz, did I miss it or did you erase it? I could have sworn I saw you post. I missed. Where was it? Let me find it. And remember, guys, if you're like, oh, I think he might have missed my chart, let me know. I don't ever want to miss a chart. I don't ever skip charts. There it is. I got you. Man, that was at 10:10. That was a while ago. Sorry about that. Let's take a look. Oh, odds favorable. Great bottom. Pull back to support inside of triggers. Stop keeps you safe. Divergence prints. Don't lose. Make 25 bucks on a failed trade. I love this. Large chart rules are solid. Small chart entry is great. It just didn't work out. And if you were trading 2 contracts, Boaz, you would have been paid at 100 and then out break even. You took a tick. You took a shot. You had all the rules met. absolutely perfect. And when it failed, you didn't give any back. You didn't rely on hope. Great job on that one, man. Great job. Sorry I missed that one. I never intend to. All right. Odds favorable. So on this particular trade, better dad, let's see. Clear path, no. And then do you see these yellow 1-to-1s that the triggers haven't broken? Not a clear path. And it just didn't reach the entry. But you know exactly where it comes from. Areas inside. And then 3 divergences, no more trades. How is it that on your 4th picture, every picture is getting better and better? And make sure you cancel that sell limit up there. You don't want to accidentally get that one hit. So on this one, it's terminations. But you know exactly where the entries are coming now. I love this. Appreciate that. You're just a good student. You're keeping it simple. And man, there's so much time to get outside of the basic stuff. Once you learn the basics. I love it. Little bit every day, guys. Little bit every day. One of my favorite discoveries this year is Kaizen. And it's the Japanese philosophy. It encourages continuous improvement. And it's 1% better every day is the goal. 1% better every day. 1% better. Well, today I'm working on momentum. And then tomorrow I'm going to work on path. And then after that, I'm going to work on entries. And eventually, by getting 1% better every day, I'm going to put myself in a good position. And that's kind of how trading is. You've got to make the mistakes so you learn how to fix them. That's what the classroom's for. And then you got to learn how to follow your rules because that's where the advantages are. And that's what repetition is. The more you trust something, the more likely you are to do it. So crude oil read, let's talk about it. Do I have odds favorable momentum? Well, on this one, let's start with which direction is the trend, up or down? Background color. No, background color, Jeffrey Dean. It's 100% background color. Red is down. All right. Do I have momentum to the downside? The smalls are below the large. Do you guys recognize the colors there? The colors don't match. So I don't have momentum. I don't have a clear path down. This is a good thing you're not a stoplight. Yes. Guys, I don't have momentum. There's nowhere to go down. I'm not even in an uptrend. Do you see how, if you're a trend trader, there's just nothing to do here? This is where I have to sit still for a little bit. And I'm just waiting. I'm waiting for those advantages to come in. I'm waiting for a pattern that I can prove wins more than it loses. No, gap theory is not happening because the large triggers are right at the mid band, Jeffrey. The gap theory says that if price hits the mid band and the large triggers are a full bar away, exhibit A, that's your gap theory, brother. This is a pattern I like to call the go make a sandwich pattern. Go pet the dog pattern. Pause the class for 2 minutes and go pee pattern. There's nothing to do here. This is the waiting point. This is the 90%. This is the do nothing. I hate doing nothing. I'm not good at doing nothing. But when price reaches Fibonacci support with weak triggers, my do nothing is I'm sure as heck not going short. Wayne, that's probably an awesome look to take a shot at that heartburn, right? Even that one probably might have produced a little for you when you let it hit. Yeah. I think there may be something to that, Wayne. Possibly, maybe. I'll do that. When I start seeing y'all's plans, sometimes I just start working on it. Hey, what's going on, Paul? How are you, man? Always good to see you in here. All right, new Nevada Dale. Been a long time since you've been in here. You watched one of last week's classes. 2 quick questions. What is the white EMA you and John have on some charts? It's just that. It's an EMA. What is the momentum trade you were calling the chili dog? Okay, awesome. So the EMA, Dale, is just an EMA. So your mid band is an EMA. Your and it's a NASDAQ thing. So on the NASDAQ, you know, my brother and I trade trend trades. Yeah, I bet, Wayne. We'll let NASDAQ come up real quick. So that EMA, it just, I don't know, John came up with a little methodology that he's studying right now. And anytime John studies a methodology, it shows up in the templates, I guess is the best way to put it. But all it is he's using it more. I'm trying to see if I can find. He's using it more. Are you on the good side of it? That's really it. There's no magic to it, but there's no Nexgen rules that go with it. Just an EMA. There's people who is it? Janesh teaches a little bit. It's a 21. There you go. If you download the newest workspaces, like if you go to the resources, I know it's been a while, it will show up on the NASDAQ chart from the resources on the indicators. Or you can just, if you want to put one in, and again, if you don't really have rules for it, I don't know why you would. It doesn't do anything to keep you out of not having rules met. Like there's no magic in it. But you can always go right click an indicator. You know how? You're good? Oops, I'm still calculating, so I'm probably going to crash. Okay. And yeah, it's part of the NinjaTrader stuff. So go look at it. It's kind of being on the right side of it for a trend trade, I think, is where he's going with it. Look at that. That's a bunch of shenanigans in the NASDAQ. Divergence, termination, 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 termination. All right, and then the chili dog. So the chili dog is a trade that was created by a guy named Ron. I need to check on Ron too. He's from Myrtle Beach and there's a lot of fires. So one of the things that I always say, Dale, is that decisions are made at key areas, and you've been around, you know that, right? This fib could create a bounce, right? And you can see that it did. You see the tails? So key areas can create bounces, retracements. They can create problems. Are you comfortable with that concept? So the idea of the chili dog is that if you let the back of the price bar get away from the decision-making process, so you let price completely clear the area, and as long as you have odds favorable momentum on both charts, that's where price will be when the back of the bar clears. Let's go to the small chart and see what it looks like. The idea is that you can use momentum. It's a momentum-based trade, so if you don't have momentum, you don't have a trade. So there's that circle. And you're clearing problems, and it's a jump in and hope for the best. It's a jump in and hope that momentum carries you to a $110 win. It's a small, quick profits. And then, Dale, there's my study on it. I just dropped the Word document in there. And in that Word document, here, I'll pull it up. I don't mind, I don't really teach it. So odds favorable momentum on the large chart. Back of the price bar clears areas on both charts. Oh, really, Paul? You'll dig this one. And then you just enter with a buy or sell market. So the management, you're holding for 110 or a 7-tick stop. That's it. And then there's a lot of pictures of it in here, and even pictures of when it's not met. So it goes back to that core concept that decisions are made at key areas. And I love it, because if you look at a large chart, and then better dad, this is why terminations cost so many people money. See the tails? Those tails are retracements. Happens at a fib, happens at the 1-to-1s, happens at the fibs, happens at the fibs. Big tails at fibs, right? We know exactly where these reaction points are. So the chili dog says, let's let price get to the other side of it. And if I have a clear path on both charts, whoops, I'll look for an entry. Was that it? Yeah, that was it right there. So on this particular one, the entry wouldn't have been until you got below the divergence low. And then you're looking for $110 once you clear it. Does that make sense, Dale? Guys, once you understand momentum and path, you're going to figure stuff out. Well, he would have played the strong trending market thing, but you're absolutely right, Better Dad. This is odds favorable momentum. That's weak triggers. I was more going off the lesson of clearing the problem. And guys, this isn't a Nexgen trade. It's really not even something that I teach. But I just taught it. I know it. I know the rules. If you're trading it, I'm happy to hold you accountable for it. If you're learning it, I'm happy to look at all your pictures and help you with it. And then Dale, there's Wayne's study on it. Yeah, but he can't click your pictures. So you'd have to give him the actual pictures. Otherwise, it's just a screenshot of your screenshots. Mine's got a bunch of clickable links on it. And again, just like anything, the best of the best is odds favorable momentum, right? And here's a good one. Termination, odds favorable, room to the mid-band. That would be a chili dog right there. It's nothing but momentum getting you to the next trouble spot. Awesome. I love it when you guys help each other. It's pretty cool. And then, Paul, if you need any help or have any questions, let me know. Be fun having you playing in class again. But Dale, let me give you a heads up, my friend. The chili dog tends to not work as well if the market isn't moving, right? Or on crude or on gold, it tends to fluctuate, stop you out, and then run. You would have to do some adjusting. And the same is true on NASDAQ. You have to do some adjusting. My buddy Marty, good friend of mine, known him for 35 years, 38 years, gave him software and a computer, and that's the only trade that I taught him. And he sends me screenshots every day, up 800, up 1,000, up 1,400. I think he's funded 2 or 3 prop firm accounts just with the chili dog. It's the only trade he knows. And it's all momentum and path. All right. Weekend triggers. And what you have here is a pretty good look. It's still momentum. It's not the best, Dad, but it is a clear path. Sell limit order 1 tick below 1-to-1. So I'm going to give you a cool lesson here. Are you ready? And this is for everybody. And I think we talked about this one. You'll like this. And I'm telling you, this is what we do. And I have to ask, why are you watching so many markets? I like it. So the rules say, once you get the reversal bar, identify the triggers so you know where the retracement is most likely to occur. Do you remember that part of it? And then once you identify the triggers better, Dad, you're going to find the areas within, right? And that's where the bounce is most likely to happen. And that's a cool Excel, Wayne. Better, Dad, does that make sense? So first, reversal bar, find triggers, find areas inside. Enter 2 ticks below lowest area. Are you with me, Better Dad? That's just rule number 3, typed out. Does everybody get that? Triggers define where the retracement is most likely to go, areas within where the bounce is most likely to happen. But here's kind of the key, is if you're waiting for a reversal bar, and the reversal bar doesn't even print until the other side of these 1-to-1s, well, these 1-to-1s aren't creating a bounce, are they? So they're out of the equation. Sure. But if this reversal bar prints above where I want it to bounce, then these 1-to-1s did not create a bounce. So now I have to look for the areas above the reversal bar, and there's none inside of triggers, and that would be a no trade scenario. So let's find one. Let me go see if I can find a real world example. So here it is again. It's okay, that's part of it. It's called the fear of missing out. Wayne, thank you for that. That's awesome. Guys, I'm telling you, this is the best community ever. So here's your reversal bar. Right, Better Dad? The 1-to-1s can't create the bounce because price is already on the other side of the bouncy point. So you start looking for the areas below it. And sure enough, the midband's where it came from. Here the midband is the only area inside of the triggers. As you come up here, the reversal bar is already above the fibs. The fibs aren't where I expect the bounce. And the midbands are outside of the triggers. So language starts to pay dividends a little bit. If you let it start with the reversal bar, and then I'm not trying to confuse you, Better Dad, but what you took right at the 1-to-1s, whoops, hold on. What you took right at the 1-to-1s, that's the look for the Nexgen momentum trade, which means that with momentum and nothing in the way of the potential to break, you're just taking a little snapback. And the rules weren't met, but that would be the look. And when this fails, if the rules are met, it becomes the trend trade. You're off to a great start, though. You are letting the large chart lead the way. Don't give that up. Entries will come. And remember, you understand momentum now. You're already a third of the way there. You're day 1, and you're starting to get termination conditions. Give it a couple days. You'll get there. But keep trying to enter. We'll talk about every one of it. We'll keep talking about every one of it. And eventually, all of this becomes second nature. That's it. That's all you can do. And then you start seeing different ways to enter the market. You start seeing different opportunities based on those very basic core concepts. And that's the whole idea behind this classroom, is to give you a solid foundation just so you can make good decisions. And with that, ladies and gentlemen,